Good morning, everyone, and welcome to today's class called Pension and Social Security Income. We're going to be looking at two different types of income today, falling into two main categories, one being retirement plans, pensions, and annuities, and the other being Social Security and railroad retirement. And we're going to spend the majority of today's class on that first category because there's quite a bit to cover and a lot to discuss. But before I got going, I just wanted to throw something at you to see whether this is a question that most of you know the answer to or whether it's a question that leaves you wondering a bit. So I've just put up a quiz question on the board in front of you, and I'd like you to tell me what the correct answer is. So just take a minute here. We'll read it together. It says, Alicia, age 40, withdrew $5,000 from her 401k plan during the year. In which of the following situations can she claim an exception from the additional 10% tax? So read through the possible four choices and select your choice, and we'll see how most of you do. The correct answer is actually A. And although the other options there can be an exception to the early distribution tax, they apply only if the early distribution is from an IRA. All of the exceptions you see listed apply to IRAs, but only one of the exceptions listed applies to 401ks, and that is A, to the extent that her medical expenses exceeded 10% of her income. So we're going to be getting into some of these exceptions, or all of these exceptions, a little bit later in today's class. So with that little introduction to the morning, getting your brain going, we're going to move on to the second page of the manual in just a second. But firstly, I wanted you to look at the reading references for this course. If you're really intent on studying the issues of pensions and annuities and IRAs, really the diversity of reading material out there is quite extensive. In fact, there is a category of tax professional out there called an enrolled actuary. An enrolled actuary is someone who specializes in retirement plans and actually passes an IRS exam to become certified by the IRS as an actuary. And so there are people out there who know a whole lot more about this topic than I do. But nonetheless, I've been able to get a pretty good handle on most of the topics that are in here. And just to tell you where all of my references come from, you will see them in this list of reading materials. For today's class, I added a new category that is being covered, which comes from publication 970, Tax Benefits for Education. And if this is a class on pensions, why on earth would I add a category about education? Well, you'll soon see why. And the reason I've done it is because this tax season, we had 2 or 3 clients right in the middle of tax season get CP 2000 letters from IRS because of issues revolving around distributions from Section 529 plans. So I decided it was time to update our manual and include a little bit on this because since IRS has decided it's time to start harassing people over it, it's time for me to make sure people are educated on what to do when it happens. We then have the objectives of today's course. And then we move on to employee pensions and annuities starting on page 2 of the manual. And when it comes to studying the issues of pensions, annuities, IRAs, there's a few things that IRS wants you to understand, and that is the terminology that it uses. So if you're reading information in an IRS publication or instructions for an IRS form and a particular term is used, you understand the meaning of that term. So we're going to start at the beginning just by understanding some of these terms. And we're going to first look at the word contribution. And for IRS, a contribution means to put money into your retirement account or invest into your retirement account. That can be done either through salary deferral at your job, or if you are doing it outside of your job, you could just be making direct contributions to an IRA or to an annuity. A distribution is the opposite, and it means to take or withdraw or receive money from your retirement account. So when you put money into your account, we call it a contribution. When you take money out, we call it a distribution. So how do you know when you've made a contribution, or is there a way to track when a contribution has been made? And the answer is sometimes, or often you could even say. There are different mechanisms in place to track contributions to accounts. And some of these are done outside of the control of the taxpayer because they're being done by people who manage these funds. And other times they are within the hands of the taxpayer, and the taxpayer is really responsible for tracking these contributions. And you can imagine when the taxpayer is responsible for tracking contributions, they may not be so good at it. The comments I get from my clients so often are, how many years do I have to maintain these tax records? IRS says 3 years. Is 3 years enough? And I go, well, it depends. Personally, I'd never throw them out. You never know when you're going to need them. But in all honesty, 7 years is probably enough. However, when you're dealing with things like contributions to IRAs and basis of assets and rental properties or other assets that you've purchased for investment purposes, really, you need to be hanging on to those records for as long as you hold those assets and then another 3 years beyond the time you dispose of them. So that can be a very long time. But coming back to the matter of on a year-to-year basis, is there anything being done to track contributions to these plans? The answer is yes, there are things that are done to track contributions. And when you look at a W-2, that is one of the places that you can see a contribution is being tracked. And in this case, it's the employee's contribution. It wouldn't show the employer contribution to the plan, but it does show the employee's contribution. And you can see that this W-2 has a code D with $17,500 next to it. And that tells me that this employee made a contribution or a salary deferral contribution to their 401k plan. Now, other contribution codes you might see in here fairly often include the code E. Code E indicates that there was a contribution to a 403b plan. And less commonly, there may be other codes in here as well. But for the most part, I'm used to seeing Ds and Es in these boxes. Now, that's what happens in terms of how to track a contribution through your work and your job. But what about making contributions to IRAs? Is there any way to track your contribution, or is there anyone who's tracking the contributions you make to your IRA? And the answer is yes, but it's a fairly recent thing. It's done with a form called 5498. And I can't tell the exact year this form came out, but it wasn't that long ago. It seems like it's been around for about 10 years now. And what this form does is it provides information to the IRS and to the taxpayer as well as to when contributions have been made to an IRA and the type of IRA that the contributions were put into. Now, the form does more than just that. And so we're going to take a look at the form itself and some of the purposes that it has. So Form 5498 is submitted to the IRS by the custodian of your individual retirement account to report the following information with respect to every single IRA that you own. Firstly, contributions including rollover contributions, also Roth IRA conversion amounts, recharacterized contributions, the fair market value of your account on the last day of the year, as well as required minimum distribution amounts for the year. And the amounts that's shown on the form may be or may not be reportable on your tax return. So for the most part, this form is brought to us by our clients, and we look at it and we go, that's interesting, okay, and we shove it aside. In other words, no, it's not very interesting at all. But actually, it does contain very significant information that may be relevant in the current year or it could be relevant in future years, and it's worth taking a look at to make sure that it doesn't contain information that leaps out as triggering some kind of filing requirement somehow. So we go up to the top box and it says IRA contributions other than amounts reported in other boxes. For example, box 2 is one of the other boxes that it lists, and that's where we would put rollover contributions. So if you make a direct contribution to your IRA account, then the amount that you contribute during the year should be reflected in box 1 of the form. And if you made a rollover contribution, that is, you rolled money from one retirement account into this account, then it would be indicated in box 2. If you do a Roth conversion, it means you took money from a traditional IRA or from a 401k plan and you rolled it into the Roth account, and that becomes a Roth conversion. And then finally, it shows the fair market value of the account in box 5, and it's referring to the fair market value of the account on the last day of the year. The fair market value of the account on the last day of the year could be the only number that appears on this form, and very often it is the only number that appears on the form. If no contributions were made during the year, no rollovers, no recharacterizations, nothing really exciting happened with the account at all, you may get this form and it'll simply tell you the year-end value of the account. Recharacterized contributions refer to amounts that were converted from a traditional IRA into a Roth IRA and then sent back, and we call that a recharacterization. And we have a number of other boxes on here as well, including SEP contributions, simple contributions, Roth IRA contributions, and also then we get down here to something that says RMD, and that relates to required minimum distribution and the date of it and the required minimum distribution amount. We're going to talk about RMDs later in today's class. So let's move down to the next heading on here where it says contributions. Of course, any contributions you make to an IRA are required to be reported on this form, and the form will show you the amount contributed for the year and the year-end balance. Direct rollovers, transfers, and recharacterizations, there's boxes on that form for those as well, and we're going to cover each of those items. And then finally, the required minimum distribution. Now, Form 1099-R is used to report distributions from retirement accounts, whether you are getting your distributions from a IRA account or from a 401k plan. The 1099-R form is all-inclusive, and it is used for all of those accounts. And when we receive a 1099-R, we do need to pay attention to the boxes that are on it, so we're going to cover those in a minute. But before we do that, I wanted to come to the front page of the 1040 form and show you that we actually have two different lines on the form that are used to report distributions from retirement accounts. Line 15A is used for IRA distributions, and line 16 is used for pensions and annuities. So when you're reading the 1099-R document, you do need to pay attention as to whether this is an IRA document or whether it is a pension or annuity document, for nothing other than to make sure you get that amount reported on the correct line of the 1040. Now you'll notice that each of these lines has two slots. Line 15A is where you show the gross distribution from an IRA, and line 15B is where you report the taxable portion of that distribution. It is possible for line 15A to be smaller than line 15B, and I have also seen situations where more often line 15A is larger than line 15B, but I have seen situations where line 15A was smaller than line 15B. So line 15A, IRA distributions, line 16A, pension and annuity distributions. So in box 16A, you will see the gross amount of the distribution from all of the non-IRA accounts during the year, and then line 16B will show the portion of those distributions that is taxable. Now, depending on your software program, it may be the case that if the total distribution and the taxable part of that distribution are the same number, then line 16A could be left blank and you will only see a number in 16B. You can have numbers in both boxes, but it is not uncommon to see the software carry only one number over when the numbers are the same. All right, moving on to Form 1099-R. Itself, we're going to be taking these boxes one at a time. I like to do this because part of our job as a tax professional is to be able to read and interpret these documents. If our clients were that great at it, then they wouldn't need us, would they? So I feel one of our important functions is knowing how to read these documents, how to make decisions about the numbers that appear on these documents, and then knowing what to do with the numbers in terms of preparation of the tax return. So beginning up with box 1, box 1 is where the gross distribution from the account is entered. It shows all of the amounts that were distributed from the account during the year. And box 2A shows the taxable amount. The taxable amount may or may not have a number on it. Very often it doesn't have a number on it. And when there is no number in box 2A, you will see a checkbox for 2B with a check mark in it or an X in it. And what that means is that the plan administrator does not have enough information to know what the taxable amount is. And I would say happens a lot. I couldn't tell you whether I see a number in box 2A more often than not. So what do you do when the taxable amount is not determined? How do you determine what the taxable amount is? You can assume that the taxable amount and the gross distribution are the same unless you can show to the contrary, unless you have some information that leads you to believe that the taxable amount is less than the gross distribution. So as we're going through today's class, we'll look at some reasons why the taxable amount can be less than the gross distribution, and we'll also show how you make those calculations. And then we go over to box 2B with the total distribution box checked. That simply tells you that that was a complete distribution of all of the funds in the account. In other words, this account has essentially been closed. It could be because they emptied it all out, took the cash and went, or it could be because they did a rollover into another account. But either way, when the account has been completely emptied, you will see the total distribution box checked. Capital gain included in box 2A. Certain types of distributions from plans of individuals born a long time ago, before 1936, can qualify for special tax treatment. And if you took a distribution from a plan that belonged to a person born before 1936, then there could be a number in this box. Box 4, federal tax withheld. This is a rather important box, just as with a W-2. Federal tax withholding is the difference between owing or having a refund. And what do you do when a client has had too much or too little tax withheld? Presumably they've had some, but I see certain situations quite often where tax clients don't have anything held out at all. We then have Box 5, employee contributions to designated Roth accounts or to insurance premium type accounts. And Box 6, net unrealized appreciation in employer securities. Distribution codes, Box 7, distribution codes are important, and you should know the most common ones. They should be in your head that you know what they are. They're Code 1, Code 2, Code 4, Code 7, Code L. When I flash those off, do they have a meaning to you? Because they should, because they come up all the time. So the code tells you what kind of distribution this was and how to treat it on the tax return. And then next we see a box for IRA Simple. If this box is checked, you're dealing with a distribution from an IRA, and the distribution is reported on line 15 of the tax return. If this box is not checked, then you are dealing with a distribution from something other than an IRA, and the amount is reported on line 16 of the tax return. There are some other boxes in here that have to do with designated Roth accounts. Those include boxes 10 and 11. And then in box 12, we can see state tax withheld, the state payer identification number, the state distribution amount. As often as not, I see these boxes blank. There seems to be a general pattern that if you are receiving distributions from a retirement account from an employer that is in the same state in which you performed your services, you'll typically see that they do the state withholding. But if you were a California teacher, retired from the California education system, and then you moved to another state like Oregon, it doesn't seem to be the case that those retirement plans will withhold for other states. They'll withhold for their home state or nothing. Completely different than what you see with W-2s, where an employer does need to register in every state that they're doing business in. And if their employee is in a different state than they're in, they still have to register that employee in that state and pay payroll taxes to that state, do withholdings for that state. But with these pension plans, I've never really explored why. Apparently they are treated different. And it is very often the case that they just simply won't do state withholding. And when that is the case, if you have a client who lives in a state and the pension administrator or retirement plan administrator will not do state withholding, then essentially they're left with paying estimated taxes if they want to stay on top of things and not owe at the end of the year. Now, we're going to just flash through these box descriptions until we get down to box 7. I wanted to spend some more time on box 7 because, as I said, you need to have certain numbers memorized in your head. And the first one that I mentioned was Code 1. Code 1 means early distribution with no known exception to the early withdrawal penalty. And the very first question I gave you at the top of today's class, that particular individual who received her $5,000 from her 401k plan would have received a 1099-R, and it would show a distribution amount in box 1 of $5,000. Presumably the taxable amount is also $5,000. The IRA box would not be checked, and there would be a distribution code of 1 in box 7, and that would tell me, okay, this is an early distribution from a 401k plan with no known exception. So maybe if I interview her and get some information from her, I'll find something. But the problem is when it's 401k distributions or essentially non-IRA distributions, the list of exceptions shrinks dramatically. In particular, there is a good list of exceptions, but they very rarely apply, whereas the ones that are withheld for IRAs only are the ones that come up the most commonly. Number 2, early distribution exception applies to the early withdrawal penalty if under age 59.5. So you may have had an early distribution from your retirement account, but it is not subject to a penalty, or at least the plan administrator believes that it is not subject to a penalty. And if that's the case, they put a code 2 there. Now, I often see a code 2 used when we're talking about Roth conversions. We're going from a traditional IRA into a Roth IRA. I might see a code 2, but a code G could also be in there for that exact same purpose. So code 2 could be there for any number of reasons. When there is a code 2, I just go, great, there's no penalty to worry about. But of course, the distribution is still taxable. Code 3 is for disability. In other words, the person became totally and permanently disabled, and now they are able to receive distributions due to that disability, and they're not going to be subject to a penalty because of that. Code 4, death. This includes payments to the beneficiary, referred to as a death benefit. So essentially someone you knew died and they had a retirement account, and now you've inherited that retirement account and you are taking distributions from it. You will see a code 4 in there, and that code 4, or perhaps there isn't a code 4, maybe there's a code 1, and it should be a code 4, and you're going to claim an exception to the early distribution penalty because actually you have inherited this retirement account and you are required to take distributions from it, and they are not subject to the penalty. Interestingly, both code 3 and code 4 appear on the 1099-R, but they're also the equivalent of the exception codes when we fill out 5329. If you can think of an exception to the early withdrawal penalty for taking money from an IRA account early, on both 5329 and on the 1099-R Box 7, codes 3 and 4 have the same meaning, disability and death benefit. And then we have a variety of other codes, but I'm not going to read them all because they don't come up too often until we get to code 7, which is for normal distributions, not subject to the early withdrawal penalty. Someone has essentially retired and now they're starting to take their normal distributions. Code 7 is what you would expect to see, and it simply means that there's nothing special about this 1099-R, business as usual. Going on down the list, we come to one that says code B, designated Roth distribution. A designated Roth account distribution should be non-taxable, assuming it's a qualified distribution. And then we move down to code G, direct rollover and direct payment. When you move money from one retirement account to another retirement account and the plan administrator does that for you so that you're not essentially touching the money at any point, just rolls from one automatically into the other, then you should see a code G. And if you are taking the funds from one IRA to another IRA, that should be a non-taxable transaction. If the funds are coming from a 401k and being transferred into your IRA, that also should be indicated with the code G and be a non-taxable transaction. Code H, direct rollover of a designated Roth account distribution to a Roth IRA. Code J, early distribution from a Roth IRA with no known exception to the early withdrawal penalty. Code J pops up relatively often. I would say this is one of the more common ones I see. But remember, when you see an early distribution from a Roth account, the amount of the distribution will invariably be more than the taxable part. So just because you see a code J doesn't mean the entire distribution is taxable. Because remember, everyone who has a Roth IRA automatically has a basis in it because you can never make a non-deductible contribution to a Roth. You always have a basis in your Roth, and therefore figuring the amount of income and any penalty you might have to pay on an early distribution from a Roth account, when you see a code J, you're going to have to do some computations. Code L, these are loans that are treated as distributions. It is possible to borrow money against your 401k, never against your IRA, but it is possible to do it against your 401k. And if you take a loan against your 401k plan, typically you're required to make repayments over a period of time. And if you separate from that particular employer during the year, or if you default on the repayments during the year, then any outstanding balance will be treated as a default of the loan. And as soon as you default on the loan, it is treated as a distribution, and if you were under age 59 and a half, then you would also be subject to the early distribution penalty on that. Moving on down, I would say the next one to be concerned about is code S, early distribution from a simple IRA in the first 2 years with no known exception. If you took an early distribution from a simple IRA in the first 2 years, then you are dealing with a pretty big penalty, 25%. And then finally, we have some other codes here that would come up less commonly. Code T for a distribution from a Roth IRA if you do not know if the 5-year holding period has been met, but you are at least age 59 and a half, or the participant died, or the participant is disabled. And code W, charges or payments for purchasing a qualified long-term care insurance contract. So those are the codes that should be appearing in Box 7 of the 1099-R, and it's really your job to know what they mean. Now, one of the things I mentioned is that your client should have had federal tax withheld from the distribution. As long as they've had enough income to be required to pay tax, you should be seeing some form of withholding on that document, and especially when people first retire, or if there's some kind of change financially for them during a period of retirement, it may be necessary to adjust the amount of withholding that's going on. Smart taxpayers who have a good relationship with their tax professional will be realizing that retirement is a significant event in their life, and it's not uncommon at all for my clients to request appointments to see with me and consult with me in between tax seasons because they're coming up on retirement. They'll come to me and say, I'm going to be retiring at the end of this year, and I really want to know what that's going to mean for my tax situation. And so we get into discussions about when they're going to start receiving Social Security and how much that will be, how much they're going to be receiving as pension income, is the other spouse, if there is one, still working, are you going to continue with a side job after you start receiving retirement income? That's a lot of information to process, and essentially the purpose of it all is to dummy up a tax return for the future years so you can predict where they're going to be. And once you've done that prediction, you might be able to tell them, well, I think that you need to have this rate of withholding. The thing with W-4P and the thing with W-4 as well, W-4 being the document that you give to your employer to tell them how much tax you want to have withheld, both these documents work off the exemption system. And I find the exemption system to be confusing, to say the least, because it's misleading. I talked about this quite a bit in my class on wage income last week. When you go through and read all of the instructions here, they are confusing. For example, enter one for yourself if no one else can claim you as a dependent. You are single and have only one pension, or you are married and have only one pension and your spouse has no income subject to withholding. That's a lot of information, and what it's essentially saying is you can claim one exemption if you have no other source of income, and you are the only person that that income is supporting. One should be about right, and that's true. As soon as you have more than one pension, as soon as you have more than one source of income, in other words, any other source of income, one is going to be inadequate. And it could be the case that you have multiple pension accounts. None of them are very large. Like I have a number of clients who they have 10 IRA accounts, and every year they're receiving 1099-Rs for all 10 of these accounts. When you add all 10 of the accounts up, you've got a fairly substantial total amount that is coming to them each year. But taken individually, each account might be giving them anywhere from $2,000 to $10,000 a year. And if you put single one on every one of them, there will not be nearly enough withholding. So frankly, there's not much more that you can do than go single zero unless you make a determination that you want to have an additional amount held out each month from the plan. And you can see here that it says additional amount, if any, that you want withheld from each pension or annuity payment. And this is where you could just enter a flat dollar amount. So maybe you'll go single zero, and then you'll see where that places them in terms of withholding. Maybe it's going to take a year to get there. And then you can say, okay, well, you've under withheld for the year by $3,000. So let's just put $300 a month or $250 a month into this box that needs to come out for every pay period. Most of these pay out every month, and that'll hopefully bring them up. Now, I've had a couple of clients that we've struggled with these concepts for 2 or 3 years, trying to kind of find the right balance. And then after about 2 or 3 years of struggling to get some kind of coordination going on between the plan administrator for their retirement account as well as other forms of income that they have, we finally make this break-even point that they're quite delighted to have. Moving on to more retirement plan definitions, one of the things you may have noticed, I've certainly noticed, is there's a lot of different names out there for all different kinds of plans. And perhaps you are retired and you are getting money from different kinds of plans, and you've been investing in these types of plans throughout your lifetime, and they make perfect sense. But perhaps you're a person who doesn't have any of these plans going on. You have no direct experience with them, you haven't studied them, and all of the names can kind of be confusing. And so I've included a little section in here on what the different terminologies or types of plans mean. Firstly, we have pension. And a pension is generally a series of definitively determinable payments made to you after you retire from work. Pension payments are made regularly and are based on such factors as years of service and prior compensation. An annuity is a series of payments under a contract made at regular intervals over a period of more than 1 full year, and they can be either fixed, under which you receive a definite amount, or variable, that is not fixed. You can buy the contract alone or with the help of your employer. A qualified employee plan is an employer stock bonus, pension, or profit-sharing plan that is for the exclusive benefit of employees and their beneficiaries and that meets certain Internal Revenue Code requirements. It qualifies for special tax benefits such as tax deferral for employer contributions and capital gain treatment for the 10-year option if you happen to have someone that qualifies for that, which is rare. There's also the qualified employee annuity. A qualified employee annuity is a retirement annuity purchased by an employer for an employee under a plan that meets Internal Revenue Code requirements. A designated Roth account is a separate account created under a qualified Roth contribution plan to which participants may elect to have part or all of their elective deferrals to a 401k, 403b, or 457b plan designated as Roth contributions. Elective deferrals that are designated as Roth contributions are includable in your income and are not eligible for that salary reduction. So if we go back up to that W-2, on this W-2 that we saw at the very start of the class, you can see code D. It shows $17,500. And if we take $17,500 and add that to $104,500, we're going to get the amount in box 5, which is $122,000. And the reason box 5 is higher than box 1 is box 5 actually represents the true compensation that that employee received for the year. But not all of the compensation they received for the year is being subjected to income tax, and that's because this employee did a salary deferral to a 401k plan and does not need to pay income tax on the money that went in. If the money, however, had gone to a Roth account instead, then there would be no amount showing as a salary reduction here, and the amount in box 1 would be equal to the amount in box 5. And so Roth accounts, when you have a designated Roth account at your job, it means that instead of making pre-tax contributions to that account, you're making after-tax contributions to that account. Now, a designated Roth account and a Roth IRA operate similarly, but they are not similar. They are different types of accounts. They do not mean the same thing. The rules that apply to them are different. The one commonality that they have is that money that goes into them is not deductible currently, and presumably if all the plan requirements are met when distributions begin to occur, they would be tax-free. Next, we have tax-sheltered annuity plan. A tax-sheltered annuity plan is often referred to as a 403b plan or tax-deferred annuity plan, and it is a retirement plan for employees of public schools and certain tax-exempt organizations. Generally, a tax-sheltered annuity plan provides retirement benefits by purchasing annuity contracts for its participants. Now, there are different types of pensions and annuities, and they can be divided into the following categories. Firstly, fixed period annuities. In these, you receive a definite amount at regular intervals for a specified length of time. Annuities for a single life, you receive definite amounts at regular intervals for life, and the payments end when you die. Also, we have joint and survivor annuities. When the first annuitant receives a definite amount at a regular interval for their life, and then after he or she dies, a second annuitant will receive a definite amount at regular intervals for life. The amount paid to the second annuitant may or may not differ from the amount that was paid to the first annuitant. Variable annuities. Here you receive payments that may vary in amount for a specified length of time or for life, and the amounts you receive may depend on such variables as profits earned by the pension or annuity fund, cost of living indexes, and or certain earnings from a mutual fund. And then finally, disability pensions. You receive a disability payment because you retired on disability and have not reached the minimum retirement age. Next up, we're looking at individual retirement account IRA definitions. We've been looking really at the annuity definitions here. Now we're going to be looking at the different types of IRA definitions to get into your head. If you refer to publication 590A, Contributions to Individual Retirement Accounts, and other IRS references that are provided, they give you definitions for IRAs, and I've essentially taken those and consolidated them here for you, at least the key points that you should know. Firstly, we're going to look at what is an individual retirement account. Now, back when I first arrived in the United States, back in 1989, I came to the United States from Canada, married an American, and shortly after that actually opened my own IRA. And back then, there really was only one IRA that I was aware of. Certainly on the tax return, you didn't have the same number of choices. There could have been the SEP IRAs. Those were probably around. But in terms of choice between a traditional IRA and a Roth IRA, there was no choice. It was just an IRA. You either had one or you didn't. And over the years, other types of IRAs have come up. So let's talk about these in turn. And we're firstly going to look at the broad definition of what is an IRA. And of course, IRA stands for Individual Retirement Account. It means it is a self-managed account. It doesn't belong under a plan administered by your employer that your employer might be controlling. It's under your control, so you can invest that IRA in the types of things that you typically might want to invest in, with restrictions, of course. But you're deciding where to put your investments. So back when I opened up my first IRA account, I had a list of different mutual funds I could buy into, and I thought about those accounts and made a choice. And I could come along later and change that choice if I wanted. Those are possibilities. So, individual retirement account is a trust or custodial account set up in the United States for the exclusive benefit of you or your beneficiaries, and the account is created by a written document. The document must show that the account meets all of the following requirements. Firstly, the trustee or custodian must be a bank, a federally insured credit union, a savings and loan association, or an entity approved by the IRS to act as a trustee or custodian. So what this is telling us right now is that the typical place you're going to go to open up an IRA is not that hard to find. You could just go to your bank or your credit union if you want to open up an IRA, but it could be that you have a relationship with a broker of some kind, and so you go to that broker and you use them. But you don't have to look any harder than your local bank if you want to open up an IRA. Now, the trustee or custodian generally cannot accept contributions of more than the deductible amount for the year. However, rollover contributions and employer contributions to a simplified employee pension or a SEP can be more than this amount. So what that means is there is a limit on the amount you can contribute to an IRA each year. It is based upon your age as well as your compensation. And today's class is really about income from IRAs and not about contributions to IRAs. So those specific limits that can determine how much you are allowed to put in your IRA are actually covered in a different class that I'm teaching later this week called Above the Line Deductions. So when we get into Above the Line Deductions, we're going to be looking at the opposite side of the IRA, and that is putting money in. Today, we're looking at taking money out of IRAs and how to treat those distributions from IRAs. Now, contributions to an IRA must be in cash. In other words, you cannot contribute property to an IRA. You have to contribute cash to the IRA. But once that IRA has cash, it can use the cash to purchase other assets. You must have a non-forfeitable right to the amount at all times. In other words, there can't be a penalty where you lose some of your benefits for distributing them early. The money in your account cannot be used to buy life insurance. Assets in your account cannot be combined with other property except in a common trust fund. And you must start receiving distributions by April 1st of the year following the year in which you reach the age of 70 and a half. So those rules apply to all IRAs, except for this last one. By the time you reach age 70 and a half, it does not apply to Roth IRAs, and we're going to look at those next. A Roth IRA is an individual retirement account that generally is subject to the rules that apply to a traditional IRA. It can be either an account or an annuity, and to be a Roth IRA, the account or annuity must be designated as a Roth IRA when it is opened. A deemed IRA can be a Roth IRA, but neither a SEP IRA nor a simple IRA can be designated as a Roth IRA. So differences between the Roth and traditional IRA, well, for the Roth IRA, contributions are always non-deductible. You cannot deduct contributions to a Roth IRA. Lots of the time, you cannot deduct contributions to a traditional IRA as well. Again, when we get into our above-the-line deductions class, we're going to be talking about when a contribution to a traditional IRA is deductible and when it isn't. But when you're looking at a Roth account, you're never allowed to take a deduction. Now, with a Roth account, qualified distributions are tax-free if you satisfy the requirements, but with a traditional IRA, the distributions will be either fully or partially taxable. Contributions made to an IRA can be made after you reach the age of 70 and a half, and there is no required minimum distribution amount from your Roth IRA as long as you are alive. Traditional IRA, the definition of that is any IRA that is not a Roth IRA or a simple IRA. A simple IRA plan provides small employers with a simplified method to contribute towards their employees and their own retirement savings. Employees can choose to make salary reductions, and then the employer is required to either make a matching or a non-elective contribution. Contributions are made to an individual retirement account or IRA that is set up for each employee, and that it is called a simple IRA. The big thing to note about simple IRAs is that if you open the plan and then within 2 years of opening the plan, you take the money out, it's subject to a 25% penalty. specialty. And then the final category of IRA is the Simplified Employee Pension Plan, or SEP. A SEP allows employers to contribute to traditional IRAs that they set up for their employees. A business of any size, even a self-employed person, can establish a SEP. Determining the taxable portion of your distribution is the next topic of the day, and I feel like we're close enough to the point where we can take a break that I'm going to let you do that, because I've been talking a lot with a lot of definitions and you're probably falling asleep on me. So let's take a 10-minute break. So I'll see you in 10 minutes. Password number 1 is Perth, P-E-R-T-H, Perth. Hello, everyone. Welcome back to class. We're going to pick up with the next segment of the day. Up until this point, we've really just been talking about definitions to understand some of the terminology of retirement accounts and how to read documents that are issued relating to distributions from those retirement accounts or relating to contributions to some of those retirement accounts. Now we're going to look at more meaty stuff. Really, part of what we're doing when we're talking about retirement income is our client has come to us, they've had some retirement income during the year, and how do we determine how much of that retirement income is going to be taxable to them? I would say 70, 80%, even 90% of the time, determining the taxable portion of a distribution is pretty simple. It's whatever's in box 2 of the 1099-R, and you could say, well, I'm done. But it's those situations where the number in box 2 is blank or perhaps even incorrect, which is less common, that we're going to have to be using our noggins and our knowledge of tax law in order to determine that taxable amount. So that's what we're getting into with this segment of the class, determining the taxable portion of your distribution. Your distribution from your retirement account can be partially or fully taxable. Usually it's fully taxable. But to be partially taxable, you must have made after-tax contributions to the plan or annuity, and your after-tax contributions are considered to be your cost in the plan. If you think about it, you could equate it to something like your cost in an asset that you might purchase. How much did I pay for that car? If I sell the car, I'm probably going to sell it for less than I paid for it, which is why I have no income from the sale. Less commonly, you might sell a car for more than you paid for it, in which case you'd have a profit or a gain on the sale. When you're investing into a retirement account, it's a little less simple, because when you put money into a retirement account, it's really hard to know what your exact cost is when you take money out. Is this the dollar I originally invested, or is this the dollar that I originally took out? It doesn't work that way. So IRS actually has some formulas and rules in place for determining how much of a distribution is taxable. So how do you determine it? Well, firstly, you have to determine if you've made any after-tax contributions to the plan. Because if you made only pre-tax contributions to the plan, then you have no cost in the plan, and that means that 100% of your distribution is taxable. But if you made after-tax contributions to the plan, then some of the distribution from the plan is going to be a return to you of that cost, and your job is to determine how much of the distribution is going to be allocated to a return of cost, and therefore not taxable. So let's talk about cost, or investment in the contract. Before you can figure out how much, if any, of your pension or annuity distribution is taxable, you must first determine your cost in the plan. And the total cost includes amounts you paid and amounts that your employer paid that were taxable to you at the time that they were paid. If all of your contributions were pre-tax contributions or were made for you on your behalf by your employer, then you do not have cost in your plan and the distributions are fully taxable. If you made non-deductible contributions to a retirement plan or annuity, the payer could indicate the taxable portion of the distribution in Box 2B of your Form 1099-R, and if Box 2B is blank, you figure the taxable portion of your distribution by completing the simplified method worksheet, and I will show you that a little bit later in the class. So I typically see that most retirement accounts that have a plan administrator in charge who knows what they're doing, they're going to be figuring the taxable portion of the distribution for you. And usually any amount that's not taxable is going to be fairly small. For example, it's not at all that uncommon for me to see a 1099-R. If we go back to a 1099-R, I have one coming up pretty quick, I think. Yeah, here's one. It's not uncommon for me to see a 1099-R where box 1 says gross distribution of $12,000, say, and box 2A will say taxable amount $11,900. And so there's only $100 of the total distribution that's non-taxable. And when I see that box 2A is less than box 1, I might notice, not always, but it can be the case that there will be a number in box 5 that would equal the difference. In this case, that would be $100. So when you get a 1099-R that is showing a taxable amount in box 2A and then a number in box 5 that if added to 2A equals box 1, it's telling you that the plan administrator has done all of that figuring for you, and it makes our job pretty simple. But if that work has not been done for us and our client knows that they have a cost in the plan, then the only way we're going to be able to figure out that cost is by doing the simplified method worksheet. So the next part is to look at Form 8606. So if there's no plan administrator figuring out what the taxable part of a distribution is, then you're going to fill out the simplified method worksheet if you're dealing with a pension or annuity. But if you're dealing with an IRA, there's no plan administrator working on that for you ever, because you're the administrator of your plan. You're going to have a trustee that handles the contributions and manages the account for you. But in terms of tracking what's going into it and where that money came from, that's essentially your job. And when you're dealing with a distribution from an IRA, you're going to report that distribution using Form 8606 if the contribution you've made to the account is non-deductible, or you've taken a distribution from the account and you have at least a partial cost in that distribution. So Form 8606 is where we're going to spend a little bit of time now. It's a fairly complex form, and few preparers that I've run across actually understand the form or how to fill it out, which is why we're going to spend a fair bit of time on it today. Now, Form 8606, as I said, has two functions. It handles contributions to an IRA account, and it also handles distributions from an IRA account. You will use the form when you make a non-deductible contribution to a traditional IRA, or you make a Roth conversion from a traditional IRA or another kind of retirement account, or you do a recharacterization. You also use the form when you take a distribution from an account in which you have a cost. Today we're looking at income, reporting of retirement income, so we're going to be looking at the distribution side of Form 8606. In our next class, in just a couple of days, on above-the-line deductions, we're going to be looking at how to use Form 8606 when we make a contribution to an IRA. But today we're looking at it in terms of taking distributions. So if you withdrew money from a traditional IRA in which you have a cost basis, you use Form 8606 to report the amount of the distribution and to calculate the taxable part of the distribution that you took. If you do not have a cost in your IRA because all contributions to the IRA were fully deductible in prior years, or perhaps the money that came into that IRA is there because it was through simple contributions from your employer, or perhaps it was from a rollover from a 401k plan to your IRA. If any of those applies, then you have no cost in the plan, and that would mean 100% of your distributions are taxable, and you don't need to complete 8606 at all. So the only time you complete 8606 with respect to distribution is when you know that you have a cost, because you're going to use Form 8606 to determine what portion of the distribution is not taxable because of that return of cost. So let's look at a list of situations where Form 8606 is required. Firstly, you made non-deductible contributions to a traditional IRA for the year, or you received distributions from a traditional, SEP, or simple IRA during the year, and your basis in traditional IRAs is more than zero. You converted an amount from a traditional SEP or simple IRA to a Roth IRA, or you received a distribution from a Roth IRA during the year. Or you received distribution from an inherited Roth IRA that was not a qualified distribution, from an inherited traditional IRA that has a basis, or you rolled over an inherited IRA plan to a Roth IRA. So let's take a look at Form 8606. As I said, it's a fairly complex form. It's 2 pages with multiple parts. In Part 1, you'll see that the header on this is non-deductible contributions to traditional IRAs, as well as distributions from traditional SEP and simple IRAs. And in this top portion here, we're going to use lines 1 to 3 to show non-deductible contributions to the traditional IRA that you made for the year, as well as your basis in your traditional IRA at the end of the year. And then on lines 4 through 15, you fill these lines out only if you took a distribution from your IRA for the year. So if you made a contribution to your IRA during the year, less space to have to fill out, but when you take distributions, there's a little bit more work going on. Then when we move over to the next page, we have Part 2, and we complete Part 2 only if you converted a traditional SEP simple IRA to a Roth IRA during the year. And Part 3, distributions from Roth, you will complete Part 3 if you took a non-qualified distribution from a Roth IRA during the year and you need to figure the taxable part of that distribution. So let's say you received a 1099-R, and in box 7 it shows a code J. That would tell you that you're going to need to complete Part 3 of Form 8606 to determine what part of the distribution that has a code J next to it is going to be taxable and what the amount of early distribution penalty will be. So let's take a look at an illustration of how to complete 8606 for an individual who is taking a distribution. Our character's name in this story is George Jetson. He is retired, born in 1950. During the year, his income included $15,000 of Social Security benefits and distributions from his pension plan and his traditional IRA. George's basis in his traditional IRA for 2013 and earlier years was $40,000, and his IRA has a value of $200,000 at the end of 2014. His 1099-Rs and Form 5498 are attached. You can see here on this Form 5498, it simply shows the fair market value of his account at the end of the year and the fact that this particular account is for an IRA. That's all the information that's on it. But this $200,000 number, it's important. We need it. So we're going to move on now to the next document that he received, and you can see it is a 1099-R for $12,000, taxable amount not determined. It shows a distribution code of 7, which means it's not subject to any kind of early distribution tax. The IRA box is checked. That tells us that we're going to use Form 8606 because it is an IRA, and we're also going to report the distribution on line 15 of the 1040. And then we move on to another 1099-R. This one is for $42,000. The IRA box is not checked. It also has a code 7, meaning it's also a normal distribution, but it's going to be reported on line 16 of the tax return because it is not an IRA. Then we move on to the next part, which is to complete the Form 8606 for George. And I'm going to zoom in here a little so it's a little bit easier to see what I'm talking about. And we can see that Part 1, we're entering nothing on line 1 because he made no contributions to the plan during the year. But we do know that his basis at the beginning of the year was his basis at the end of 2013, and that was $40,000. So we're going to enter $40,000 as his cost in his IRA. And then line 6 says, enter the value of all your traditional SEP and simple IRAs as of the end of 2014. And that's where we use the amount shown on the 5498 document. That's the starting number. The next line is to enter the amount that was distributed from the IRA for the year. That was $12,000. And then we add $12,000 of distributions from the year-end balance to get a number that hypothetically represents the high balance in the account for the year. It's not going to be exactly the high balance because he could take a distribution on January 30th and leave the account in a much lower number than the amount it has at the end of the year, $200,000. Or conversely, instead of going up in value during the year, the account could have gone down in value during the year. But regardless of what's really going on inside the account, we simply need to know that we're going to take the year-end balance of the account and add that to the distributions from the account to get a number that we enter on line 9. Line 9 hypothetically represents the high value of the account for the year. We then look at what the percentage distribution is compared to the total balance in the account. So line 10 says divide line 5, this number up here, by line 9, which is this number right here. So we're going to take 40,000 and divide that by 212,000. And then we enter the total result as a decimal amount, 0.1887. That essentially means that 18.87% of the value of the account is cost in the plan. And therefore, 18.87% of any distribution from that plan for this year is going to be a tax-free return of cost. So we're going to take 1887 and multiply that out. And when we do that, you can see here on line 12 it says multiply line 7, which is the distribution amount, by line 10, the percentage that is taxable. When you do that, you get $2,264. So $2,264 is 18.87% of $12,000. This is the tax-free return of cost, the portion of the distribution that is non-taxable. The next step is to subtract $2,264 from the total amount that was distributed, $12,000. The net difference is $97.36. So right now I know that on the Form 1040 on line 15A, I'm going to enter $12,000. And on line 15B, I'm going to enter $9,736. The next step is to move on to the 1040 and do that very thing. So on line 15A, we're going to enter $12,000, and on line 15B, we're going to enter that $97.36. We then move down to line 16A, and on line 16A, we can see that the taxable amount is blank, and that's simply because that's what our tax software does. It's probably somewhere in the IRS instructions as well, but if line 16A and line 16B are the same number, you're only going to fill in line 16B, and his second 1099-R was for a non-IRA account, so on line 16B, we enter $42,000. He also received Social Security benefits during the year of $15,000, and it turns out that most of those are taxable. He's going to enter the taxable part of his Social Security benefits on line 20B. That's $12,750, and we end up with total income for the year of $64,486. So that's a little bit on how to complete 8606 for distributions from a traditional IRA and to figure the tax-free return of your cost that you apply to that distribution. Now, rollovers are another topic that we should be spending some time on. They happen all the time, and what you're supposed to do with those rollovers is important. If you withdraw cash or other assets from your qualified pension plan or IRA, you can defer tax on the distribution by rolling funds over into another qualified plan or IRA. Now, when it comes to rollovers, IRS really means something quite specific. They mean that you go to your retirement account, your IRA usually, and you take the money out. And then you, I don't know, hold on to it or spend it or whatever with it. But within 60 days of that distribution, you put it back in another account or the same IRA again. And when you do that, it's called a rollover. If the rollover is done within 60 days, then you don't have to include it in income or pay tax on it. So when you take our money out as a rollover, you have those 60 days to put it back in and avoid taxation. You can choose the direct rollover option by having the administrator of the old plan transfer the distribution directly to a new plan or IRA. If it doesn't touch your hands at all, then you should see a code G in box 7 of the 1099-R. If it does touch your hands, in other words, you do take money from the IRA, you should see a code 1, assuming you are under age 59.5, in box 7. Now, if you choose to withdraw your taxable portion without rolling it over into a new plan, the plan administrator must withhold 20% income tax on that distribution. And that can make it a challenge if you take money out of the plan and then you decide that you're going to roll it over within 60 days, but the plan administrator has held out 20% tax. It may be difficult to come up with the entire recontribution amount. I know that it is possible to take money from your traditional IRA and tell them not to do any withholding. I've seen that happen. And when it does happen, if your intention is to roll it back in, you just want to make sure you do it within 60 days and put it all back in. If you had tax withheld inadvertently, you still have to recontribute the full amount, including the withholding, or you will be subject to taxation on any amount that was not recontributed. Now, there is a rule that you should be aware of. Beginning in 2015, you can make only one rollover from one IRA to another or the same IRA in any one-year period, regardless of the number of IRAs you own. And this is actually the result of a court case in which the IRS, the court ruled against the IRS. It was kind of an odd thing. I don't even know how it ended up in court, who took it there or why. I guess I didn't care enough to find out. The information is probably there. But at any rate, there has been a tendency for many years for individuals to have multiple IRAs, and they could borrow money from one IRA and within 60 days convert money from a second IRA into the first, right? And then within 60 days convert money from a third IRA into the second, and so on, and keep that going so that by the end of the year they've constantly had out a certain sum of money as a loan just by rolling one IRA into another IRA into another IRA. And apparently this was going on enough that for whatever reason it ended up in court. And the IRS's position that allowed for that was overturned or overruled, and the court says, no, it is one per year. So what that means is if you do take a loan against your IRA, you need to repay that loan within 60 days, and you cannot do so from any other IRA accounts you have. And once you have repaid it, you cannot take more money out again before the end of the year. Any subsequent distributions are going to be considered to be early distributions. And if you have an early distribution, of course, it's going to be subject to that penalty. Furthermore, I remember reading in the verbiage of this particular rule that if you end up contributing more to an IRA than is allowed for under the rules, so for example, you go outside that 60-day window, you take money from your IRA with the intention of putting it back in 60 days, but it actually, say, takes you 70 days, it's treated as an early distribution, and then if you put that full amount back in again, and the amount that you put in exceeds the maximum contribution amount for that year, then you would have an excess contribution that would be subject to a penalty as well. Rollovers to Roth, or another word for that is a Roth conversion. So you roll money from a traditional IRA into a Roth account. That is called a Roth conversion. And you can convert amounts from either a traditional SEP or simple IRA to a Roth IRA. These conversions are treated as a rollover regardless of the conversion method used. You may also roll over eligible distributions from qualified retirement plans to a Roth IRA. For tax years after 2007, you are also allowed to roll over to a Roth IRA all or part of an eligible distribution that you received from your or your deceased spouse's qualified pension, profit sharing, or stock bonus plan, 401k plan, annuity plan, tax-sheltered annuity under 403b, or deferred compensation plans of a state or local government. So this is a rather significant rule. When the Roth IRA account first came out, and it was named for a senator called Senator Roth, I believe they came out in 1998. At that point in time, the Roth IRA was marketed as an investment tool to attract middle income filers. It was not available to higher income filers. If you earned more than a certain amount of money, you were not allowed to put money into it. You were allowed to roll money from your traditional IRA into your Roth account, but you were not allowed to roll money from any other form of retirement account into your Roth account. And then in 2007, people said, well, that's kind of just a bit of red tape, because the reality is that you could, under those rules, roll money from your 401k plan to your traditional IRA, and then from your traditional IRA into the Roth account. So it was possible to get those funds to transfer. It just had to be done in 2 steps. So in 2007, they said, enough with the 2-step process. Now you can do it directly from one plan to the other. Now, the rollover is subject to the same rules that apply to converting a traditional IRA to a Roth IRA if you do the rollover for many of these types of plans. Also, beginning in 2010, the modified AGI and filing status requirements for converting a traditional IRA or rolling over an employer plan to a Roth IRA were eliminated. What this means is that before 2010, you are only allowed to do these conversions from traditional IRAs or from other types of pension accounts into a Roth IRA if your income was below a threshold number. And as of 2010, that threshold no longer exists, so you can have any level of income and do the conversion. Now, Roth conversions are taxable. This is a big thing to be aware of. And Roth IRA accounts are much beloved by brokers. Investment advisors sitting down with their clients love to recommend Roth accounts. They just think they're the greatest thing since sliced bread because distributions you get from them are tax-free. But they may or may not really be a good deal for a particular taxpayer, and it depends, whether they're a good deal for a taxpayer is going to depend on quite a few variables. A big one is their age. If you're 25, a Roth IRA can be a great deal. If you're 55, not such a great deal, perhaps. So we're going to talk about why that's the case in this next part of the course. And here we're looking at Roth conversions are taxable. And this is something that isn't necessarily understood by tax clients when investment advisors tell them that they should convert their money to a Roth, because the rollover conversion from a Roth IRA is not tax-free, and you have to report any amount that you roll into the Roth as income on your 1040. If the rollover was from an IRA, you're going to enter your rollover distribution amount on Form 1040, line 15. And if you have a tax basis in your IRA, you're going to complete Form 8606 to figure the taxable part of the rollover. You'll then enter the taxable portion of the rollover on 1040, line 15B. And if the rollover was from a pension or an annuity plan, you will enter the total distribution you received from your qualified pension plan that was rolled into the Roth IRA on Form 1040, line 16A. And then on line 16B, you will enter the taxable part of the distribution, and generally that is the same as the total amount of the distribution. Now, in-plan direct rollovers from 401k and 403b plans to designated IRAs, Section 2112 of the Small Business Jobs Act allows participants to make in-plan rollovers from their 401k and 403b plans to designated Roth accounts. These are called in-plan Roth rollovers. But this is different completely than doing a conversion from your 401k plan to an individually owned Roth account that is under your control. A designated Roth account is an account established by your employer that carries some of the same benefits as a Roth IRA, but it is not the same as a Roth IRA, and it has special rules that apply to it. One of the most significant of these rules is that if you make a conversion to a designated Roth account from your 401k plan, you can't change your mind later and back it out. It's done. Whereas if you do a conversion to a Roth IRA, you are allowed to change your mind and take it back out. So let's move on to the next topic we're going to look at here, which is the early withdrawal penalty, and it does not apply to these rollovers. The additional tax, which is also referred to as the early withdrawal penalty, does not apply to rollovers into Roth accounts. So when you take money out of account before you reach the age of 59.5, typically your minimum retirement age, you're typically going to be subject to that additional tax. And throughout today's class, you'll hear me and have heard me using the early withdrawal penalty. If you read through all of the IRS instructions and forms, you don't really see that term used anywhere. You just see something referred to as the additional tax. In the layperson's language, or maybe even in the tax professional's language, we think of these additional taxes as penalties for behaving in ways that are contrary to the intention of the legislatures who created these types of accounts. The idea of a retirement account is that you put money in an account and you leave it there until you retire. And if you take the money out before you reach that minimum retirement age, you're going to be punished in the form of an additional tax, which I refer to as a penalty. So the additional tax or early withdrawal penalty does not apply to rollovers into Roth accounts. And they should be reported on the 1099-R as follows. In Box 1, it will show the amount that was rolled over. And Box 2 should show the taxable amount if the payer has this information. Box 5 will show any basis that the employee has in their account. And then Box 7 will show a code G, which indicates that the plan was rolled over and is not subject to federal withholding. Now, as I said, in the case of Roth conversions, it is not uncommon for me to see a Box 7 with a code 2 in it rather than a code G. Special rules for 2010 Roth conversions. For 2010 only, any part of a taxable distribution that was for a conversion or rollover from an IRA or employer plan to a Roth IRA was given special tax treatment. The taxable portion of these distributions was included in income in equal parts in the subsequent 2 years, which were 2011 and 2012. So what would happen in that situation is that in 2010, you make a decision that you want to convert money in your traditional IRA or in your 401k plan to a Roth IRA. So you do that conversion in 2010, but you don't have to report any income from that transaction on your tax return until 2011 and 12. And then what happened in 2011 and 12 is you reported half of the conversion amount in each of those years. The benefit of that is if you decided you wanted to do that conversion, you would split the tax reporting over 2 years, and they aren't even the year in which you did the conversion. The negative part about that was that people who did it, by the time they found out how much tax they owed on that conversion, it was too late to unconvert, or in other words, recharacterize. So they were stuck with the decision, and I had one client that it cost him a ton of money, and there was nothing he could do to undo it because any decision to recharacterize had to be made by the due date, including extensions of the original return. And for 2010 conversions, that deadline was October 15, 2011, and I wasn't sitting down with him to do his 2011 return until April of the following year, and it was just too late. There was nothing he could do to undo it. So let's talk about these Roth conversion considerations. As I've said, investment advisors seem to love them. For a long time, I wondered if I was the only person out there who didn't like them. So one day I'm reading an article on Roth conversions, and lo and behold, I was reading an article written by someone who totally agreed with me that they weren't a good deal for most people. And so I said, okay, well, I'm not an oddball in this thinking alone. So let's talk a little bit about why Roth conversions may or may not be a great thing. So a Roth IRA differs from other types of retirement account in the following ways. There's no minimum age at which distributions are required, and contributions can no longer be made. So with a traditional IRA, once you reach age 70.5, you have to start taking those required minimum distributions. With the Roth account, that doesn't apply, so you could hold off until you're 80 if you like. Contributions to a Roth account are not tax deductible, and qualified distributions from a Roth account are tax and penalty-free if the following conditions are met. A, the distribution occurs after the required 5-year holding period, and one of the following applies. The taxpayer is age 59.5 or older, the distribution is due to death or total disability, or the distribution is used for a qualified purchase of a first home. I have seen people using Roth IRAs to, not just for a first home, but also college expense and things of those sorts. So there can be some other items out there that I at least have seen as motivations for taxpayers. Roth IRA advantages. Roth IRAs are popular, as I've been saying, with investment advisors who frequently promote them because income from these Roth accounts is tax-free if the conditions I just showed you and described to you here are met. Traditional IRAs, employer plans, and other retirement accounts are at best tax-deferred or merely tax-deferred. And tax-deferred means that income generated within these accounts is allowed to grow tax-free, but it is eventually taxed when the funds are distributed. But let's just think about what that tax-free growth means. Way back when I was a young thing, just entered into the United States, I sat down with my first investment advisor experience, and it didn't take any time at all for him to convince me of the merits of investing in an IRA. And he did this illustration where he said, okay, you have money in a bank account here, and it generates some income, and whatever income it generates in the form of interest, you have to put that on your tax return and pay tax on it. But if this money was inside an IRA, you wouldn't have to pay tax on the income. And that means that the income just keeps reinvesting itself, and it grows faster and bigger. And he gave me this story about a guy who had started up an IRA and disappeared for a few years and came back to him and said, yeah, I want to empty it out. And during those few years that he'd been making small investments, the account had grown to $30,000. And he was totally shocked at how much it had grown. And he said, no, leave it there. I like this. So that was the description he gave me way back when, before Roth IRAs were in existence. That tax-free growth, kind of set aside, you're not allowed to touch it, growing for your retirement. It all seemed to make sense to me. So Roth IRAs weren't an option at the time, but the traditional IRA made perfect sense just because of that tax-deferred growth internally. Now, a Roth IRA is going to presumably have the same growth inside that a traditional IRA is, but the difference between the traditional and the Roth is that when you pull money out of the traditional, it is taxable, and when you pull it out of the Roth, it's not. So what are the Roth disadvantages? Well, since contributions to a Roth IRA are not deductible, the amount of money that a taxpayer can afford to contribute currently may be more limited than is the case for tax-deferred retirement accounts. In addition, if you convert money from a tax-deferred retirement account or IRA to a Roth IRA, the conversion amount has to be included in your income. And taxes you owe as a result of the conversion are not available for investment purposes, and it may be many, many years before you are able to make up the amount of money that you lost to taxes. So let's look at some examples of what I mean. Current cost of contributing to a Roth IRA. Assume you are contributing $5,000 to a Roth IRA and your combined rate of federal and state tax is 30%. That means your after-tax cost of investing in the Roth IRA is $5,000. What about contributing to a traditional IRA? Assume you made a deductible contribution of $5,000 to your traditional IRA and your combined rate of federal and state tax is 30%. Contributing $5,000 to your traditional IRA will reduce your tax bill by $1,500, which means the after-tax cost of investing $5,000 is only $3,500. So you're going to come up with $5,000 to invest in that traditional IRA, but you're going to owe $1,500 less tax. Or maybe if you're doing it at the time you file your return, you're going to get a $1,500 refund back that you would not otherwise have had. And so the cost of investing $5,000 is much more affordable. And then let's look at another example, one of those expensive ones. This is the cost of converting a 401k plan to a Roth IRA. In this situation, we have a taxpayer named Lisa. She is 45 years old and is single, and her investment advisor convinced her to roll over $200,000 from her 401k plan to her Roth IRA during the year. Lisa's only form of income is wages, and her 2014 W-2 shows $100,000 of wages paid. Lisa is a resident of the state of Illinois. She has no dependents and will claim the standard deduction. Prepare her tax return with and without the Roth conversion to determine the amount of tax Lisa owes as a result of the conversion. So first thing we have is a W-2 showing $100,000 of income, $19,000 of federal tax, and $5,200 of Illinois tax. Moving on, she also has a 1099-R. It shows a gross distribution of $200,000, a distribution code of G because it was a rollover into a Roth, and it's a total distribution of that 401k plan with a taxable amount not determined, but because it's from an employer plan, you can pretty much assume her cost is zero. Let's look now at Lisa's 1040 form if she had not done a Roth conversion. If she has no Roth conversion, her total income for the year is only $100,000 of wage. And when we move over to page 2 of her 1040, we can see here that she claims the standard deduction. She figures her personal exemption deduction of $39.50 and figures that she has taxable income of $89,850. The tax on that is $18,341. We move down to line 64 with $19,000 of withholding, and it turns out she has a $924 refund. We move over to her Illinois state return. When we do her Illinois return, we can see that her tax on line 21 of the Illinois return is $4,894. She has $5,200 of withholding. And so on Illinois, she would have had a $306 refund without that Roth conversion. Now we move over to her federal return with the Roth conversion. And on that return, we're adding in this extra $200,000 of income. So we have the same $100,000 of wage. We add in this $200,000 of Roth conversion, and it bumps her income up to $300,000. Well, when we move over to page 2 of her form, now her taxable income has reached $291,000, and the tax bill has increased to $80,000 for the year. But remember, the income that she has to live on and pay taxes with is still only $100,000. So now she owes $80,000 of tax. She had $19,000 of withholding, which means at the federal level she's going to owe $60,739. We move over to the Illinois return, and this time it is correct to see the $300,000 of income, and the tax on that income has risen to $14,894. She still has that same $5,200 of withholding, and so she's going to owe the state of Illinois $9,694. So we move over to the next page of the manual, and here I'm basically summarizing these tax consequences for you to see what's going on. Combined cost of converting $200,000 of retirement savings from her 401k to her Roth account is $71,663 of additional tax. On her original return, the federal tax was $18,341, and the Illinois tax was $48.94 for a total tax of $23,235. When we take that Roth conversion and add it in, the federal tax increases to $80,000. The Illinois tax increases to $14,894 for total tax of $94,898. And the difference in the amount of tax she owes with and without that conversion is $71,663. Now, it is possible that Lisa could recognize significant tax savings at some future point because she's done this conversion. But the question I have is, what else could she have done with this additional $71,000? If she just left $200,000 in her 401k account, she would have had $71,000 to use for investments into IRAs, into the stock market, into a home. Apparently she doesn't own a home. She's not claiming deductions for one at any rate. She could be using that money for other things to save for her retirement. She could also be using it to live on. But she's going to not have that money. And the converse is, let's say she ends up having to borrow money to pay the tax she owes on this. Now she's got non-deductible expenses going on outside the account. The reason I harp on this is because I see this happen, and I see it happen not with great frequency, but regularly. Every tax season, I have someone come into my office who is convinced that this Roth conversion would be a good idea and then determines that they can't afford it. So is there any back door or way back out of this? And the answer is, for Lisa, there is, as long as she's making this decision within 6 months of the due date of the return. Then she can do a recharacterization, back the money back out of the Roth account into the traditional IRA account where it belongs, and not have to report that income. State income tax considerations. Most states tax retirement benefits and wages. If you live in a state that assesses income tax on your wages, and then tax deductions associated with contributing money to a tax-deferred retirement account are going to save you at the federal and the state level. But if you live in a state that does not have a state income tax, then the savings of put money into a traditional IRA can be reduced. And conversely, the tax benefits associated with a Roth account can also be reduced. It's not uncommon for me here in the state of Oregon to see people work all their careers as residents of Oregon, and then when they retire, move across the state line into Washington. Washington has no income tax. So while they're working and living in Oregon, any contributions they make to a 401k plan or a traditional IRA plan, they are able to claim deductions for against their Oregon income, in other words, their state income, and their federal income, and save tax at both levels while they're working. If they then move across the state line on retirement, any distributions they take from those retirement accounts are only going to be taxed at the federal level because the state they've moved to has no income tax. So that is something to consider when you're interviewing your clients, is just where they plan on retiring and how much tax is that going to impact them based on where they retire. Next item is recharacterizations. I've told you that it is possible to change your mind. In certain situations, you may determine that the amount of money you contributed to your Roth IRA should be transferred to a traditional IRA, and you may want to recharacterize your Roth contribution or conversion because you determine that your income is above the maximum amount allowed for Roth contributions, or after you converted money to your Roth account, the value of the account has dropped and you do not want to pay tax on the higher amount that was converted, or you discover that the tax liability that results from the conversion is too high. Recharacterization will prevent you from being required to include the recharacterized amount in your income. This one up here, you determine your income is above the maximum amount allowed for Roth contributions. I actually run into that fairly often. Individuals, they've been contributing to a Roth account every year for years, and then their income in a particular year rises above the level where they're allowed to do it. And if they haven't got it memorized in their mind what that level is, then they could be in a situation where they've made an illegal contribution to their Roth and they're going to have to get it back out. The interesting thing is that you can bypass that rule by making a contribution to a traditional IRA that does not have an income limit and then rolling that money into a Roth. It may not be that simple, though, if you have an existing amount in your IRA, because if you, let's just say you have an IRA with $100,000 in it, and then you add a $6,000 contribution amount that you then want to roll into your Roth, it isn't going to be simply that you can put $6,000 in there and then roll it into a Roth without a tax consequence. There would be a tax consequence. But those people who don't have established traditional IRAs already can, if they're earning too much for a Roth account, open up a traditional account, put the amount into the traditional account that they want to put into the Roth, and then do a direct rollover into the Roth. And I have a number of clients each year that do that. They are not really maintaining traditional IRA accounts for any purpose other than doing these Roth conversions. And that becomes advantageous for a filer when their income is above the amount where they are allowed to make a direct contribution to a Roth, and in situations where they earn too much to claim that traditional IRA deduction anyway. So again, we're going to look at who can take a traditional IRA deduction in our next class, but save it to say if you are in that income bracket where you earn too much money to make a contribution to a Roth, it is possible to make it to the traditional and then convert it into the Roth. But if you have made a direct contribution to a Roth when you are not allowed to because you earn too much, then you are required to recharacterize it or you will have to pay a penalty. Now, you can choose to recharacterize a Roth conversion or a Roth contribution subject to the following recharacterization rules. The amount of money recharacterized must be transferred from the Roth account to a traditional account in a trustee-to-trustee transfer, and the election to recharacterize must be made within 6 months of the due date of the return, which is October 15 for most filers. This date applies regardless of whether an extension was filed or not. Inherited IRAs, that's the next topic that we're going to be looking at. If you inherit a traditional IRA, you are called a beneficiary. Rules relating to inherited IRAs differ depending on whether you inherited the IRA from your spouse or someone other than your spouse, such as a parent, uncle, or sibling. So let's talk about what happens when you inherit an IRA from your spouse, because these rules are important and they can get a little bit confusing, and I've actually had direct experience with some clients not knowing how to handle their IRAs just in the last few tax seasons. If you inherit a traditional IRA from your spouse, you generally have the following 3 choices. You can treat that IRA as your own IRA by designating yourself as the account owner. Or you can treat it as your own by rolling the funds that are in it into your own IRA, or to the extent it's taxable, into a qualified employer plan, a qualified employee annuity plan, a tax-sheltered annuity, or a deferred compensation plan. Or you can treat yourself as a beneficiary rather than as the IRA owner. Treating it as your own, you will be considered to have treated your spouse's inherited IRA as your own IRA if contributions are made to the inherited IRA by you, or you do not take the required minimum distribution for a year as a beneficiary of the IRA. You will only be considered to have chosen to treat the IRA as your own if you are the sole beneficiary of the IRA and you have an unlimited right to withdraw funds from it. However, if you receive a distribution from your deceased spouse's IRA, you can roll over that distribution into your own IRA within the 60-day limit, as long as the distribution is not a required distribution, even if you are the sole beneficiary of the deceased spouse's IRA. Now, what happens if you inherit an IRA from someone who is not your spouse? Well, if you inherit a traditional IRA from anyone other than your deceased spouse, you cannot treat the inherited IRA as your own. This means you cannot make any contributions to the inherited IRA, and you cannot roll over any amounts into or out of the inherited IRA. Now, when you're looking at a 1099-R for an inherited IRA, it should have a code 4 in box 7, and that tells you that it's an inherited IRA, but it will probably also say something up to the effect of, this IRA is in the name of the decedent for the benefit of whoever it is that is inherited. You are allowed to make a trustee-to-trustee transfer of one IRA that is inherited into another account, but it has to retain that beneficiary IRA designation. So amounts can be moved from one account to the other and set up and maintained in the name of the deceased IRA owner for the benefit of you as the beneficiary. Like the original owner, you will not owe tax on the assets in the IRA until you receive distributions from it, and you must begin receiving distributions from the IRA under the rules for distributions that apply to beneficiaries. IRAs with basis. If you inherit a traditional IRA from a person who had a basis in the IRA because they made non-deductible contributions, that basis remains with the IRA and the following rules apply. You cannot combine this basis with any basis you have in your own traditional IRA or any basis in traditional IRAs you inherit from other decedents. There is an exception, and that is if you are the decedent's spouse and choose to treat the IRA as your own. If you take distributions from both an inherited IRA and your own IRA, you will need to complete a separate Form 8606 for each IRA, but only if both IRAs have basis in them. And the thing is, if you inherit an IRA from a decedent and they had a basis, how would you even know what that basis is? That, again, falls back on record keeping, and I suppose it's possible there's people out there doing it. Pretty savvy, investment conscientious people would probably have that, but I'm not seeing it very often. Loans from pension plans, these have a distribution code of L. You may be able to borrow money from your qualified pension or annuity plan, tax-sheltered annuity plan, government plan, or contract purchased under any of these plans to purchase a first home. If you close out the plan prior to paying back the loan, or if you default on paying back the loan shall be considered a distribution, and you may have to include in income all or part of the amount that you borrowed unless certain exceptions apply. And in case you're wondering what those certain exceptions are, you can go to this link here that will take you to hardship distributions for qualifying hardship distributions. Additional taxes. Pension plans and IRAs are given special treatment to encourage people to save for their retirement. Penalties exist in the form of additional taxes if the funds within a plan are withdrawn early, referred to as early distributions, or the minimum required amount is not distributed, not receiving the minimum distribution. And there should be a third one here. I've just realized I don't have it here, but that would be excess contributions. You've got too much in there. You put too much in for the year and didn't take it out. That would be a third reason why there would be an additional tax. Tax on early distributions, that's what we're going to talk about first. The tax on early distributions is commonly referred to as the early withdrawal penalty, and you are going to be required to pay an additional 10% tax on your early withdrawal from your qualified retirement plan, IRA, or annuity if you withdrew funds before you reach the age of 59 and a half. The tax applies to the taxable part of the distribution. There is a 25% additional tax for early withdrawals from a simple IRA if the distribution occurs within the first 2 years of participation in the plan. If this penalty applies to you, there will be a code X in box 7 rather than a code 1. Also, there is a 5% additional tax on certain early distributions from deferred annuity contracts. Now, I know that the state of California also has an early distribution penalty that it charges as well. Oregon, the state that I live in, does not have that, but since California does, it wouldn't hurt to take a look at the specific rules for the state that you are working in and be aware of any early distribution penalties they may have. How do you report an early distribution from an IRA, pension plan, or annuity? Well, typically, you're going to report the distribution from your IRA on line 15 of your tax return, and you're going to report the distribution from a pension or annuity on line 16. And that's basically the end of it. You're going to figure a 10% tax, and when you do, you're going to enter that 10% tax on line 59, and you're done. But if you feel your client has an exception to the penalty, in other words, they may not need to pay all or a portion of that penalty, then you can claim an exception to the penalty. So we're going to talk about what those are, and then we'll take a break. There are a number of situations in which the tax for an early distribution does not apply. Situations that qualify as exceptions to the additional tax include payments made as a series of substantially equal periodic payments at least once per year for your life or life expectancy, or the joint lives or life expectancies of you and your beneficiary. If the qualified plan is not an IRA, you must have separated from servicing your employer. So this does come up sometimes. We'll get someone who comes in with a 1099-R and they're only 50 years old. And we're wondering, why does it not show a distribution code 1? Instead, it would actually show a distribution code of 2, meaning it is an early distribution, but they're not subject to the penalty. And it would be because essentially they've retired early. And now they've figured out what the annuity lifetime frame is, the amount of regular periodic distributions they can take are, and they've started to do that. And in that situation, although they're under the age of 59 and a half, they're not subject to the penalty. Also, if they receive a payment because they became totally and permanently disabled, there's no penalty for that. Or payments made to the beneficiary on or after the death of the plan participant. So it's telling me that if you've received payments from a plan after the death of the participant, it shouldn't be subject to the penalty. I'm not seeing a clause that says under age 59 then half for the plan participant, but I will look that up. Payments made from a qualified retirement plan other than an IRA after your separation from service in or after the year you reach age 55. But if you are a public safety employee, like a police officer, you only have to be age 50. Payments made from a qualified retirement plan other than an IRA to an alternate payee under a qualified domestic relations order. That's a fancy word for divorce. You've gotten divorced, you've got a plan, and you've been ordered as a part of that divorce, qualified domestic relations order, to make a distribution to the ex-spouse or the current spouse during the divorce process. Under that qualified domestic relations order, you're not going to have to pay the penalty. So that's a pretty important one to know, because I do see that one come up occasionally. Payments from a qualified retirement plan to the extent you have medical expenses in excess of 10% of your adjusted gross income, or 7.5% if you or your spouse is age 65 or older. Payments made from an employee stock ownership plan for dividends on employer securities held by that plan. Payments made from a qualified retirement plan due to an IRS levy of the plan. So if the IRS comes along and says you need to take a distribution of the plan to pay taxes that you owe to us, we're not going to make you pay the penalty on it. And then also qualified distributions to reservists who are serving on active duty for at least 180 days. Those are the exceptions that apply to 401ks and to IRAs. We have additional exceptions that apply only to IRAs. And they include to the extent of medical insurance premiums you paid while you were unemployed, to the extent of your higher education expenses that you paid through cash, loans for yourself, spouse, your children, or grandchildren, or up to $10,000 can be withdrawn penalty-free for the first-time home purchase, so long as the home purchase occurs within 120 days of the distribution. So how do you claim an exception to this early distribution tax? Well, to claim the exception, you have to complete Form 5329. And a 5329 is a multiple-part form, 2 pages long. When we're talking about the early distribution penalty for retirement accounts, you're really only looking at Part 1, which is not very long. And on Part 1, you would enter the amount of the early distribution that you received. And then on line 2, you enter the amount of the early distribution that qualifies for an exception. And then in the space next to the space provided on line 2, you would enter the appropriate code. And these are the codes. And the codes are essentially a rehash of everything I've just explained to you. Code 1 is for qualified distributions that are taken as a series of payments after a certain age. Code 2 is a similar thing. And then Code 3 is distributions made to total and permanent disability. Code 4, distributions due to death. Then we move down to Code 6. Qualified retirement plan distributions made under a domestic relations order. So if you have a client that took an early distribution from a plan under a divorce order, then you would use Code 6. If the distribution is from an IRA, and only if it's from an IRA, you can also enter Code 7 for health insurance premiums that were paid for while a person was unemployed. Code 8 if they use the money to pay for qualified higher education expenses. Code 9 if they use the money to purchase the first home, but only up to the first $10,000. So only up to $10,000 of the early distribution is accepted from the penalty. And then other exception codes are listed here as well. So here is the Form 5329. I've included in this segment here only Part 1. And on line 1, you will enter the amount of the distribution. On line 2, you will enter the portion of the distribution that is not subject to the penalty. And then in this space right here, you'll enter the code that you are using. Then on line 3, you enter the amount of distribution that is subject to the penalty. So line 1 minus line 2 equals line 3. And then you're going to take line 3, multiply that by 10%, and you're going to get the penalty that you need to include on the return. It's typically going to be 10% of the amount shown on line 3. But where it is a simple IRA, it's going to be 25% of the amount on line 3. So I promised we were due for our second break of the day, and I would say this is a good time for you to work on a classwork assignment. So I've bounced down to the back of the manual here. I'm going to put you on classwork assignment number 1 for this break. It's a super simple assignment, about as simple as I ever make them. So during this 10-minute break, you can think through classwork assignment number 1, and I'll put up a couple of question pods for you. You can tell me what your answers are during this time. All right, everyone, welcome back from break. And while we were on the break, I asked you to work through and figure the answers to this particular classwork assignment. And we can see that this particular 1099-R says that the distribution is from an IRA. That means then that the distribution can qualify for an exception for purchase of a first home as long as it's made within 120 days of the purchase of that home, and we can see here that it was within 100 days. The next rule is she took out $20,000, but the maximum amount she can exclude from the penalty is $10,000. Therefore, she is still going to have to pay tax on $20,000 of income, and she will owe a penalty on $10,000. So let's just pull up the answer key to this particular assignment so we can see what the finished return looks like for her. We can see here that 5329 has been filled out for this particular filer, showing $20,000 of early distribution. Code 9 is used to claim the exception from the penalty for first-time home purchase. $10,000 of the distribution is exempt from the penalty, leaving $10,000 subject to the penalty, and the penalty amount is $1,000. So let's move on to the next part of the manual. And we were going to talk about a new topic that I've put in here this year. It's the first time I've really talked on this subject. Up until this year, I felt that there was just no need. I never got into it. It was so unusual for it to come up. And then IRS said, well, no, it is not unusual anymore. For those of you trying to figure out what page I'm on in the manual, I'm now on page 32. So we've had these Coverdell education savings accounts, which almost no one invests in. And more commonly, much more commonly, I see clients investing in these 529 college savings plans. And many, many years we've had these accounts going on with, for me in particular, seeing clients investing money into these accounts to pay for the college expenses of their kids. And they're putting money in, they're taking money out, and that's about it. It's just never really been anything that I've ever had to deal with IRS on. And so in the back of my head, I know, okay, well, if you take money out of your college savings plan and you spend it on qualifying education expenses, it's non-taxable. So even though they've got this 1099-Q, I'm going to ignore it because it's not taxable. I know it in my head. All of a sudden, IRS has decided that it's going to focus on this particular possibility of income and send out CP 2000 letters to my clients. And this year, I had a client that received one of these CP 2000 letters, and another tax preparer in my office also received a notification from her client that she had received a CP 2000 letter from the IRS. And these nasty IRS CP 2000 letters were arriving right in the middle of the busiest part of tax season with these demands for taxes owed on these hypothetical income amounts from distributions from education accounts when we knew none of the distributions were taxable because they were all being spent on qualified higher education expenses. So we were basically having to stop everything we were doing to sit down and write responses to the IRS to explain why these distributions weren't taxable. And the other thing that I've noticed going on over the years is that I'll see tax returns that have been self-prepared. Clients will come to me for the first time, and I'm reviewing their last year's tax return, and I notice that the tax return is showing a taxable distribution from their kids' college savings plan being reported as income on their tax return and subject to a penalty. And what's happening in those situations is the taxpayer has received this 1099-Q. They're going through TurboTax or whatever software they're using, and it says, do you have a 1099-Q? And you go, yes, I do, and you enter some numbers on, and the software is making a decision that it's taxable, probably because they didn't know what they were doing and probably because there were additional information they were needed to provide, but they didn't because they didn't know they needed to or they didn't understand it. At any rate, TurboTax dumps the income on line 21 of the tax return. So that is wrong, and the IRS CP 2000 letters I've been receiving are wrong. And since I've seen a few instances of this in the last year, I'm figuring it's happening all over the place, that it must be one of the latest things that the IRS is focusing in on, and it's just time to get everyone up to speed on what to do. So today, for the first time in my class, I've got a new section where we're going to focus on Part 2 of Form 5329, which has to do with additional tax on certain distributions from education accounts. Now, there are two different types of education savings accounts that are provided for under the law, which allow taxpayers to invest money to pay qualified education expenses. Investments into these accounts are allowed to grow tax-free until such time as they are withdrawn and used to pay for qualified education expenses. The two types of accounts include Coverdell Education Savings Account and Qualified Tuition Program. Now, the designated beneficiary of a Coverdell ESA or Qualified Tuition Program can take a distribution from the Education Savings Account at any time. Whether the distributions are tax-free depends in part on whether the distributions are equal to or less than the amount of adjusted qualified education expenses that the beneficiary has for the same tax year. And taxable distributions are reported in Part 2 of Form 5329 and then on line 21 of the 1040. So let's talk a little bit about the differences between these two types of accounts. Coverdell Education Savings Accounts somehow seem to be talked about by the IRS more, but qualified tuition programs are the ones I see my clients use more. In fact, all the years I've been doing taxes, I have almost never seen a Coverdell ESA. I can think of one place where I've seen it, and I'll mention it in a minute, but other than that one time, I just don't see people investing in them. And there are some good reasons why I don't see it happening very often. Now, as a nutshell, whether you invest in a qualified tuition plan or a Coverdell Education Savings Plan, these accounts the money that you put into them is not deductible. They act like a type of Roth account, in fact, where contributions are non-deductible, and the money grows inside these accounts tax-free until such point the money is taken out and spent on qualifying education. And if it is spent on qualifying education expense, then the distribution is non-taxable to the extent that it is spent on that qualifying education expense. But if the money is taken out of the account and not spent on qualifying education expense, it may be subjected to an additional tax. And whether it's subjected to the additional tax or exempt from that additional tax, you do need to figure the additional tax or the exemption from the tax in Part 2 of Form 5329. On line 5 it says, distributions that you included in income from Coverdell ESAs and QTPs. Distributions included on line 5 that are not subject to the additional tax, see the instructions, and amounts subject to the additional tax. Then on line 8, you figure the additional tax, multiply it by 10%, and then carry it to line 59 of the 1040 form. Let's talk about the Coverdell ESA first. I'm not going to spend a lot of time on Coverdell ESAs other than to cover some basic facts that you should know about them. A Coverdell ESA is a trust or custodial account created or organized in the United States only for the purpose of paying qualified education expenses of the designated beneficiary of the account. When the account is established, the designated beneficiary must be under age 18 or a special needs beneficiary. So when you put money into a Coverdell, are the contributions deductible? The answer is no. With respect to a Coverdell, what is the annual contribution limit per designated beneficiary? Well, the answer is $2,000 for each designated beneficiary. And that's part of the reason why I see so few people use these Coverdell accounts, because $2,000 is not a lot of money compared to the cost of going to college. So if your child is born and you start making contributions the year they're born, at the age of 10 you will have contributed $20,000 maximum. And that's not even going to get them through the first year of college in a lot of places. So you keep contributing it until they're age 18 or 19. You might have managed to get it up to $40,000, which is enough to cover the first year of college. And if the plan has had really good growth, maybe it's worth $60,000, $80,000 tops. And it's just the cost of going to college these days is so high, Coverdells may give you an opportunity to invest, but it's not nearly large enough thresholds. Now, what if more than one Coverdell ESA has been opened for the same beneficiary? Well, the annual limit per beneficiary is $2,000. So husband and wife cannot each set up Coverdells. There's one beneficiary, and the total sum of all contributions to all Coverdell ESAs for that beneficiary cannot exceed $2,000. So if more than one individual makes contributions, you're going to add up the total of all contributions from all individuals for that one beneficiary, and they can't go over $2,000. Can contributions other than cash be made to a Coverdell ESA? No. When must contributions stop? No contributions can be made to a beneficiary's Coverdell ESA after he or she reaches age 18 unless the beneficiary is a special needs beneficiary. Is there an income limit to contributing to a Coverdell ESA? The answer is yes. Any individual, including the designated beneficiary, can contribute to a Coverdell ESA provided that that individual's modified adjusted gross income for the year is less than $110,000 or $220,000 if filing a joint return. If your income exceeds the threshold limit for your filing status, there's a worksheet on page 50 of publication 970 that you use to figure out the amount that you are allowed to contribute because your income is too high. And what happens if contributions to a Coverdell ESA exceed the annual limit for the beneficiary? Well, the beneficiary is going to be subjected to a 6% excise tax each year on the excess contributions that are in the account. And again, see Pub 970, page 50 for more information on how to figure the excess contribution amount and the penalty. So in a nutshell, a Coverdell ESA, you have to open the account before the beneficiary turns age 18. You can only make contributions up until they're age 18. If you put too much in, you're subject to a 6% excise tax. And if you earn too much money, you're not allowed to put money into them at all. So with all of those restrictions on them, it's not a wonder that people gravitate over to the other type of account instead. And I'll get to that in just a minute. So Coverdell ESA funds can be withdrawn tax-free to pay education expenses required for enrollment or attendance of the designated beneficiary at an eligible educational institution. One interesting thing about Coverdell ESAs is that qualifying education expenses can be either qualified higher education expenses or qualified elementary and secondary education expenses. And this is second category here, qualified elementary expenses, is actually where a client knew more than I did, embarrassingly, a few years ago. She'd taken money from her child's Coverdell ESA account to pay the cost of that child going to a private school. And I went, that doesn't sound right. That has to be taxable. And she said, nope, it's allowed. And she was right. So there is one tiny place that the Coverdell ESA comes out on top of the qualified tuition program I'm going to discuss next, and that is if the qualified beneficiary, or the beneficiary for that account, the money can be spent on attending a private grade school. If you want to learn more about qualified education expenses for ESAs, you should refer to Chapter 7 of Publication 970, and I have a link to that right here. The next topic we're going to talk about, and we're going to spend a lot more time on it, and I just made a decision as your teacher to spend more time on qualified tuition programs because those are the accounts that my clients routinely have. And aside from that one time I had a client put money away for her kids' private schooling, I never see Coverdell ESAs. What I see is the QTPs. So we're going to spend some time talking on the QTPs. Now, QTPs are also referred to as Section 529 plans, and in fact, the language I typically hear people use is 529 plan. I don't really hear the terminology QTP outside of IRS. Qualified tuition plan is what IRS calls them, but when you're talking to tax professionals and you're talking to investment advisors and you're talking to taxpayers themselves, 529 plan is the terminology that is in use. So you should be thinking of a 529 plan and a QTP as being one and the same thing. Now, a 529 plan, a qualified tuition program, is a program set up to allow you to either prepay or contribute to an account established for paying a student's qualified education expenses at an eligible education institution. QTPs can be established and maintained by states or agencies or instrumentalities of states and eligible educational institutions. The program must meet certain requirements. Your state government or eligible educational institution in which you are interested can tell you whether or not they participate in a QTP. QTP contribution limits. Contributions to a QTP on behalf of any beneficiary cannot be more than the amount necessary to provide for that qualified education expenses of that beneficiary. Well, that's a much different number than $2,000, isn't it? So if you decide when your child is around the age of 14 that it's time to get busy and you start investing $10,000 a year into that child's account, and it's okay to invest $10,000 in a year, it's okay to invest $40,000 in a year, so long as the amount that you are investing into that account is not more than the anticipated costs of sending that beneficiary to higher education. So the only restriction is how much is it going to actually cost to give them that higher education. You can't invest more than that. There are no income restrictions on the individual contributor, so you don't have to worry about how much you earn. You can still make contributions to the plan. And you can invest in both a QTP and a Coverdell ESA in the same year for the same designated beneficiary if there was a reason why you wanted to do that. QTP eligible educational institution. For purposes of a QTP, an eligible education institution is any college, university, vocational school, or post-secondary education institution eligible to participate in a student aid program that is administered by the U.S. Department of Education. It includes virtually all accredited public, nonprofit, and proprietary, otherwise privately owned profit-making post-secondary institutions. The educational institution that you are working with or interested in sending your child to should be able to tell you if it is an eligible educational institution. Now, recently, I actually ran across a client who managed to attend an educational institution that was not a qualified institution, and I was like, man, I run across so few of these, I was kind of astonished. She actually went and got a certificate in becoming a certified dog trainer, and she paid several $1,000s for a program that ran for several months, and they went out of their way to tell her that she couldn't qualify for financial aid on this, and so ultimately she didn't qualify for the American Opportunity Credit on that particular expense, and so I gave her the lifetime learning credit instead. She did qualify for that. Now, qualified education expenses. Qualified education expenses include expenses relating to enrollment or attendance at an eligible educational institution. And to be qualified, some of the expenses must be required by the institution, and some must be incurred by students who are enrolled at least half-time. Publication 970, Chapter 8 this time states that qualified expenses must meet these requirements. Firstly, the following expenses must be required for enrollment or attendance of a designated beneficiary at an eligible educational institution, and that includes tuition and fees as well as books, supplies, and equipment. So they have to be incurring those costs. Expenses for special needs services needed by a special needs beneficiary must be incurred in connection with enrollment or attendance at an eligible educational institution. Also includable are expenses for room and board, but these must be incurred by students who are enrolled at least half-time. The expense for room and board qualifies only to the extent that it is not more than the greater of the following two amounts. Firstly, the allowance for room and board as determined by the eligible educational institution that was included in the cost of attendance for federal financial aid purposes for a particular academic period and living arrangement for that student, or B, the actual amount charged if the student is residing in housing owned or operated by that eligible educational institution. You will need to contact the eligible educational institution for qualified room and board costs. They should be able to tell you what those are. I was actually really surprised. I guess I'm out of it. I'm starting to pay attention to these things because I am a mom. I have a son who is a junior in high school, and so I'm starting to think about what to do for his college. Maybe I should have been thinking of a long time ago, but I'm starting to get serious about that now, and my mind has been making decisions about where to send him. And just on a personal level, I attended university in Australia. And in Australia, my friends attended the local university while living at home, and I attended the local university while living at home. And it was just common for people to do that. And ever since I've arrived in the States, I've been rather astonished that everyone feels it's a rite of passage for their child to leave home and go live in a boarding dorm somewhere and attend college out of state at some exorbitant rate. It perplexes me greatly that people do that, but it's an American lifestyle apparently. And the latest thing that I've observed in this American lifestyle is that even locally, when people do want to attend an institution that is local to them, some of these institutions are requiring that the students live on campus. And it seems to me to be just another way to get money out of them. So people obviously could be setting up these QTPs, not just to be saving for the cost of tuition and fees, but also for this mandatory room and board that's going to be driving up costs even higher. So determining your net qualified education expenses, you must reduce your qualified educational expenses to the extent you received tax-free education assistance. You will need to reduce whatever your qualified educational expenses are to the extent that you receive tax-free education assistance. So if your cost of education is $10,000, but you received assistance from one of the sources I'm about to list, then whatever assistance you receive is going to reduce your qualified education cost. And it's important to know what your qualified education cost is in terms of determining whether or not a distribution from a QTP or from a Coverdell ESA is going to be taxable to you. So tax-free educational assistance that can reduce your cost includes the tax-free part of scholarships and fellowship grants, veterans education assistance, Pell grants, employer-provided education assistance, and any other non-taxable or tax-free payments other than gifts or inheritance received as educational assistance. The amount you get by subtracting tax-free education assistance from your total qualified education expenses is your adjusted qualified education expense. Now that we've determined our adjusted qualified education expense, now it's time to determine whether any of the distribution that we took from the QTP or the Coverdell ESA, if appropriate, is going to be taxable. And if it is taxable, am I going to have to pay that additional 10% tax on top of it? So a distribution from the earnings of an education savings account is taxable and subject to a 10% additional tax unless it meets a qualifying exception. The additional tax does not apply to a distribution that is includable in income if the distribution is made due to the death or disability of the beneficiary. or made on account of a tax-free scholarship, allowance, or payment described in Section 25A, or made because of attendance by the beneficiary at a U.S. military academy to the extent that the distribution does not exceed the cost of advanced education, or included in income because you used the qualified education expense to figure the American Opportunity and Lifetime Learning credits. So let's see how all of that would work. I've created an illustration to show you a client who is going to have to pay tax on part of the distribution, but they're not going to have to pay the penalty. And the character in our story here is named Rocky Bullwinkle. He's received this 1099-Q right here, showing that there was a $15,000 distribution from a QTP. Here, see box 5, it says check 1, qualified tuition program, either private or state, or the other choice is Coverdell ESA. Since I've checked state-owned qualified tuition program, I know that it's a 529 plan. In this case, a state 529 plan. The basis in the account is $12,000. The earnings that were distributed are $3,000, and the gross distribution is therefore $15,000. So this 1099-Q is reporting distributions from a college savings plan that he set up for his son Dudley. Dudley attended Do Right College in Whiplash, Kansas, where he had the following qualified education expenses. He spent $4,000 on room and board at Do Right College. He had tuition and fees of $12,000, books and supplies of $1,500, and he also had to have a laptop to go to school there. It was required, and it cost him $800. So his total education expenses for the year totaled $18,300. Now, Rocky's income includes $75,000 of wages, and Dudley qualifies Rocky to claim the American Opportunity Credit. Rocky's 1099-Q, again, is shown there, and I'm just going to bump down now to have a little bit of a discussion how we're going to determine the qualified education expenses for Dudley. So Dudley's qualified education expenses are equal to the distribution he took from his QTP. However, some of the expenses are going to be used to claim the American Opportunity Credit, and this is going to reduce the amount of qualifying expense he has for purposes of determining the taxable portion of the distribution that is coming from that 1099-Q. Since Dudley is using $4,000 of qualifying expense to claim the American Opportunity Credit, he's going to need to reduce his qualifying education expense from the QTP as follows. He's going to take $18,300 of qualified education expense, and he's going to subtract out $4,000 that is used to calculate the American Opportunity Credit. That leaves him with a net qualifying expense of $14,300. And if we bump up here, we'll see that the gross distribution is $15,000. Since the distribution is more than the qualifying expense, some of the distribution is going to be taxable. And now it's time to do this worksheet that you see right here to figure out what the taxable part of the distribution is. So we begin on line 1 where it says total distributed earnings from the QTP. Well, that is the amount shown in box 2, earnings, $3,000. So that's the starting point, $3,000. Then it says, what is the adjusted qualified education expense? Well, we've determined that that's $14,300. And the total amount that was distributed from the QTP, we remember, is $15,000. We're going to take line 2 and divide that by line 3. And when we do that, we get 0.953. What that means is that 95.3% of the distributed earnings from this account are going to be tax-free. In other words, just under 5% is going to be taxable. So we look at this $3,000 number up here, which is the only portion of the QTP that is taxable at all, and determine what portion of the income generated within that account is going to be taxed. And we do that by saying how much is not going to be taxed. Well, 95.3% of $3,000 will not be taxed, and that totals $2,859. So we're going to subtract $2,859 from $3,000, and that leaves only $141. So that's a lot of work to determine that of this $15,000 gross distribution with $3,000 of earnings and $14,300 of qualified education expense, that $141 is going to be taxable. So what do? Well, we take that $141 and we enter it on Form 5329 in Part 2 on line 5. And then we say how much of that early distribution is not subject to the additional 10% tax? Well, all of it is not subject to the additional tax. So we're going to go over to Form 1040, And on line 21, we enter $141, and in the space provided, we enter QTP distribution. And then on page 2 of the Form 1040, on line 59, we're going to enter 0 because no penalty is owed on that distribution. And you'll see on page 2 of the form that Rocky is claiming the American Opportunity Credit. He's got $1,500 of non-refundable credit on line 50 and another $1,000 of refundable American Opportunity Credit that he's claiming on line 68. So he's getting $2,500 of credit in exchange for reporting $141 of income on his tax return. I guess you could say that's a good trade-off for him. Moving on with the Form 5329, there are still more parts to discuss. Most of these parts you will rarely, if ever, need to consider. But if these items do come up, you should be familiar with where you go to report them, because 5329 has space for much more than what we've already talked about. Now we're going to get into the section where there's a bunch of 6% penalties that can be imposed, and they are imposed really due to excess contributions to plans. So whether it's an HSA, an Archer MSA, a Coverdell Education Savings Account, a Roth IRA, or traditional IRA, anytime you make an excess contribution to one of these accounts, you can be subject to an excise tax of 6%. And if you determine that you have made an excess contribution to one of these accounts, you can get out of the excess contribution tax simply by removing the money from the account in a timely fashion. So you can avoid the excess contribution penalty if you withdraw the excess by the due date for filing your return, including extension. The withdrawal of the excess contribution amount is treated as a tax-free withdrawal if you do not take a deduction for the contribution and you withdraw any interest or other income earned on that contribution while it was a part of the IRA. Do note that you must report and pay tax on any interest or other income earned on that contribution, and typically that is done in the year that you take the money out. So here we have Part 3 of Form 5329. You can see this is where we would figure the additional tax on excess contributions to a traditional IRA. Once you've figured out what that excess contribution amount is, you're going to, and you haven't taken it out, presumably you take it out, but if you decided to leave it in there, then the additional tax is 6%. Additional tax on excess contributions to Roth IRAs, additional tax 6%. Additional tax on excess contributions to Coverdell ESAs, 6%. Additional tax on excess contribution to Archer MSAs, 6%. And finally, Part 7, additional tax on excess contributions to health savings account, 6%. But we're still not done with 5329. There are actually 8 parts to that form, and Parts 3 through 7 had to do with that 6% excise tax on excess contributions. Part 8 has to do with sort of the opposite, and that is failure to take the minimum amount out of a retirement account. So an additional tax on excess accumulation and qualified retirement plans, including IRAs, if you are required to take a minimum distribution from your account and you fail to do so, that is when you would need to complete Part 8 to figure what the penalty will be. You must begin to receive payments from your qualified retirement plan not later than your required beginning date. The government has established these dates to help ensure that payments are made to you and your beneficiaries. The additional tax is 50% of the excess accumulation, and excess accumulation is the difference between the amount that was required to be distributed and the amount that was actually distributed. So remember, way up at the start of class, we looked at this 5498 form on page 3 of your manual, and I said that if you are subjected to a required minimum distribution, there should be a number in box 12B of Form 5498. So if your 5498 for your client shows that box 12B has $1,000 in it, you should automatically be looking for a 1099-R showing that they took $1,000 or more from that particular retirement account. If they didn't take the required minimum amount from that retirement account, then they're going to be subjected to this distribution penalty. Does that happen very often? The answer is, until a couple of years ago, I'd never seen it at all, and then in a 2 or 3 year period, I saw it happen twice, and for completely different reasons. The first place that I saw it was I had a client who brought me the paperwork to prepare his mother's tax return. And she'd been living in another state. She'd been pretty much living independently, but Alzheimer's was taking over, and she'd started to lose her memory. And essentially, they brought her from the state that she was living in to Oregon, stuck her in a nursing home, and took charge of her finances. And in doing so, determined that she hadn't filed for a couple of years. And not only hadn't she filed for a couple of years, she hadn't taken her required minimum distributions. So she had those 5498s showing what the required minimum distributions were and hadn't taken them. So was there a way out of that problem? The answer is yes, there is. In order to get out of that problem, we had to essentially make the claim that she was not cognitively functioning well enough to know that she needed to make these distributions, wasn't capable of taking the actions necessary to ensure she received those required minimum distributions, and we asked the IRS for relief, and it was granted. So she did get out of that. The other situation I had for a client with regards to required minimum distributions was a client who had inherited an IRA from her father. He died, and she and all of her siblings, I think there's 3 other siblings, had all each inherited a quarter of this IRA. And life goes on. She's busy, stresses, getting over the grief of her father dying. Somewhere along the line, she's having a conversation with one of her siblings who tells her that she should have taken required minimum distribution. And that was the first she heard of it. And then she said when she started to think about it, she did remember getting some sort of paperwork about the required minimum distribution, but she didn't really know what it meant and hadn't been paying attention. And so by the time I found out about it and the time she was asking me questions about it, we were well past the date where she should have reported the required minimum distribution and a penalty on her tax return. So that was in the past. We didn't even find about it until it was in the past. And interestingly, the IRS has never come back and adjusted those returns, never figured it out on their own. That surprised me. But at any rate, we did decide to start taking minimum distributions in the year that we figured it out. And in the earlier years, I said, if they figure it out, they can come after you, and they just never did. So let's talk a little bit about those rules for required minimum distributions. So if you do have one come up, you're at least kind of familiar with what to say and what to do and not too embarrassed for being caught off guard. Because it is easy with these obscure things that don't come up very often to get caught off guard and really not know what to advise your clients on. So you cannot keep retirement plans in your account indefinitely. You generally have to start taking withdrawals from your IRA or your retirement plan account when you reach age 70 and a half. Roth IRAs do not require withdrawals until after the death of the owner, and the minimum amount you must withdraw from your account each year is your required minimum distribution. The RMD rules apply to employer-sponsored plans, including profit-sharing plans, 401k plans, all of the normal types of plans, as well as to non-Roth IRA plans, including IRAs. But the required minimum distribution rules do not apply to Roth accounts so long as the owner is still alive. When is the date that the RMD begins? Well, annual minimum distributions from traditional IRAs must begin by the year you reach age 70 and a half. You can choose to delay receipt of your first distribution until April 1st of the year following the year you reach age 70 and a half, though. And thereafter, the required minimum distribution for each year must be made by December 31. If the first distribution is delayed until April 1st of the following year, then the second distribution must be made by December 31 of that same year. So here's an example. You are retired and your 70th birthday was June 30, 2014. You reach age 70 and a half on December 30th, 2014. Therefore, you must take your first required minimum distribution by April 1st of 2015 because that is April 1st of the year following the year you turn age 70 and a half. But let's change it just slightly and make you one day younger. You are retired and your 70th birthday was July 1st, 2014. You reach age 70 and a half on January 1st, 2015. That means you do not have to take a required minimum distribution for 2014, and you must take your first required minimum distribution by April 1st, 2016. But what that does mean also is that you would have to take a second distribution for 2016 by the end of the year. Distributions after the required beginning date. The required minimum distribution for any year after the year you turn age 70 and a half must be made by the end of that year. For example, you reach age 70 and a half on August 20, 2014. For 2014, you must receive the required minimum distribution for your IRA by April 1st, 2015, and you must receive the required minimum distribution for 2015 by December 31 of 2015. If you do not receive your required minimum distribution for 2014 until 2015, both your 14 and 15 distributions will be included in income on your 2015 tax return. If an IRA owner dies after reaching age 70 and a half, but before April 1st of the next year, no minimum distribution is required because death occurred before the required beginning date. Even if you begin receiving distributions before reaching age 70 and a half, you must begin calculating and receiving required distributions by your required beginning date. For Roth accounts, there is no required minimum distribution during the lifetime of the owner of the Roth IRA, but following death, the Roth IRA required distribution rules apply to the beneficiary. Qualified retirement plans other than IRAs, in general, you must begin to receive distributions from your plan no later than April 1st of the year in which you reach age 70 and a half or the year in which you retire, even if you are age 70 and a half or older. There is an exception if you owned more than 5% of the employer that maintains the plan. Then you must begin receiving distributions no later than April 1st of the year following the year in which you reach age 70 and a half, regardless of when you retire. So in other words, what this is saying is the age 70 and a half rule applies to IRAs as well as employer-sponsored plans. However, the rule that you have to start taking out at age 70 and a half with respect to an employer plan can be delayed if you continue to work for that employer. So past age 70 and a half, but once you retire, then you have to. RMDs are not eligible for rollover. So amounts that must be distributed during a particular year are not eligible for rollover treatment. In other words, you can't take a required minimum distribution from, say, a beneficiary IRA and then roll it into your traditional IRA, your personal one, and say, oh, I don't have to pay any tax on that, because that won't work. You'll still have to treat one as a distribution, but the other would be a contribution and could be eligible for a deduction, say. Distributions greater than the required minimum distribution do not reduce the RMD for future years. So if the required minimum distribution for this year is $5,000 and you choose to take out $10,000, it doesn't mean that you've accomplished the RMD for the next year. Each year is taken on its own, and if you take out more in one year than is necessary, it has no impact on future years. Each year you look at the RMD separately. Figuring the RMD amount, how do you know what that is? Well, if you are the owner of a traditional IRA that is an individual retirement account, you or your trustee must figure the required minimum distribution for each year. You figure your required minimum distribution for each year by dividing your IRA account balance as of the close of the business on December 31 of the preceding year by the applicable distribution period or life expectancy, and there are tables for those life expectancies. If the distributions are occurring during your life expectancies, these are found in Appendix B of IRS Publication 590B. And inside of Appendix B, you will see there are three tables. There is Table 1, which has to do with single life expectancy if you are the beneficiary of the account. Table 2 is for the joint life and last survivor expectancy. If your sole beneficiary of your account is your spouse and your spouse is more than 10 years younger than you, you would use Table 2. And then for Table 3, this is the uniform lifetime table. If your spouse is not your sole beneficiary or your spouse is not more than 10 years younger, you would use that table. So I have a couple of illustrations. I didn't make these ones up. I've pulled them from Publication 590B. The first illustration, Laura was born October 1, 1943 and reached age 70 and a half in 2014. Her required beginning date is April 1, 2015, and as of December 31, 2013, her IRA balance was $26,500. No rollover or recharacterization amounts were outstanding. So we're going to find her age, which is 71, and we follow that across and see that the distribution period for her is 26 and a half years. We divide the balance in the account by the distribution period, and when we do that, we get $1,000. So her required minimum distribution is $1,000. Of course, IRS made all of these numbers balance perfectly, so they were divisible into 1,000. Example number 2, also from IRS Publication 590B, Joe, born in October of 1943, reached age 70 and a half in 2014. His wife and his beneficiary turned 56 in 2014. He must begin receiving distributions by April 1st, 2015. Joe's IRA account balance as of the end of the preceding year was $30,100. Because Joe's wife is more than 10 years younger than Joe and is the sole beneficiary of his IRA, Joe will use Table 2 in Appendix B. So he goes to Table 2 and he finds his age and he follows it across until he arrives at his wife's age. And when he does that, he uses this ratio right here, 30.1. He divides 30.1 into the account balance, and when he does that, he gets $1,000 again. It's because that's how IRS decided to make it round nicely for you. Required minimum distributions in the year of death. The required minimum distribution for the year of death is determined in the same manner as if the account owner had lived all year. If the account owner did not take the required minimum distribution prior to death, the beneficiary who inherits the account must take the owner's RMD by the end of the year. If the owner died prior to the required beginning date, then no distribution is required for the year of death only. Required minimum distributions to spousal beneficiaries. If you inherited an IRA from your spouse, your RMD depends on whether you elected to treat the IRA as your own IRA or whether you have elected to be treated as a beneficiary. If you choose to treat your deceased spouse's IRA as your own IRA, then you apply the RMD rules as they would have applied to the original IRA owner. That is, you must begin to receive distributions by your required beginning date. If you choose to treat your deceased spouse's IRA as your own IRA, then you ignore what the age of your spouse was. You only look at required minimum distributions as they pertain to you. And if you are under age 70 and a half, you don't have to take distributions at all. But if you choose to treat the IRA as a non-spousal beneficiary, then you can postpone distributions until December 31st of the year that the account owner would have reached age 70 and a half. RMD to non-spousal beneficiaries. If you are a non-spousal beneficiary, you can withdraw the entire account balance by the end of the 5th year following the account owner's death if the account owner died before the required beginning date. Or you can calculate RMDs using the distribution period from the single life table. If the owner died after required minimum distributions began, use the longer of the beneficiary's remaining life expectancy determined in the year following the year of the owner's death, or the owner's remaining life expectancy at death reduced by 1 for each subsequent year. If the account owner died before required minimum distributions began, use the beneficiary's age at the year end following the year of the owner's death, and then reducing that distribution period by 1 for each subsequent year. So what these are saying is that each year you figure your required minimum distribution, you're going to have to move down the table in terms of age. So each year the ratio changes. So it's 26.5 if you're age 71, but it's 25.6 if you're age 72. So the ratio used to figure required minimum distribution changes annually as you age. And other rules that apply to non-spousal beneficiaries. The following rules apply if you are an IRA beneficiary who is not the surviving spouse of the account holder. Firstly, the 10% additional tax does not apply to distributions. Also, you cannot treat the IRA as your own. This means you cannot roll any distributions into your own IRA accounts. You can make a trustee-to-trustee transfer to a newly created IRA so long as the new account retains the decedent's name with you as the named payable beneficiary, and you cannot make any contributions to the inherited IRA. Qualified charitable distributions. It may be that you are required to take a distribution from an IRA, but you've decided that you would rather take advantage of this provision in the law that allows you to transfer money directly from your IRA to a qualified charity, and it has to be done in a trustee transfer where the trustee sends the money directly to the charity. If it does so, then you can do up to $100,000 of distribution to a charity and claim that against your required minimum distribution for the year. Now, this particular rule, every year it's set to expire, and every year it gets extended. So it was supposed to expire at the end of 13, and then it was extended to 14. Now it's expired again, but maybe we'll be able to do it for 15 if they extend it. We'll see. And then finally, we've got annuity income to talk about. We're really due for a break, so I think we should take a break now. As is the case with breaks, I like to give you something to work on during a break, so I do have a classwork assignment for you to look at, and I also need to give you a password. So I'm going to shuffle you over to the classwork assignment first, and I can tell you right now you're not going to get through it during the break, but at least take a few minutes to think about the assignment, and then at the end of the break I'll show you the answer key. page 67, classwork number 2. Jack, taxpayer, took an early distribution from his traditional IRA during the year because he lost his job. I'm giving you a $54.98, and I'm telling you his basis in that IRA was $50,000. He spent $2,000 for health insurance premiums while he was unemployed and received the attached documents. So here's his $54.98. He has a 1099-R with the IRA box checked, and he has a W-2. Go ahead and prepare his Form 8606. So that's going to be a reasonably challenging assignment for you to try and get through in this short amount of time, but do the best you can. So password number 2 is Finch, F-I-N-C-H, Finch. All right, everyone, welcome back from break. We're going to take a look now at the answer key for this particular classwork assignment that I gave you. It was really a scrambled effort, I'm sure, for you to try and figure out what the taxable part of this distribution from the IRA was. To do that, you needed to complete Form 8606, and then I was asking you also to determine what portion of the taxable part of the distribution is going to be subject to a penalty and what portion will not be subjected to a penalty. So again, we have a taxpayer age 50. He's taken an early distribution from an IRA in which he has a basis of $5,000, but you can see that this particular 1099-R form shows that of the $20,000 distributed, it's all coming from an IRA. And if we look up here, the fact that he spent $2,000 on health insurance while he was unemployed, we can conclude that he could be eligible for an exception to the additional tax because he spent the money on health insurance while he was unemployed, and more importantly, he spent it from his IRA distribution, not from a 401k distribution. So I've got the answer key for you. I'm going to load that up. So moving over to his 1040 return, really the starting point needs to be the Form 8606. We can't do the 5329 or the 1040 properly until we've done the 8606. So I'm starting here, and on line 2, I enter his total basis in his plan at the end of 2013, which was $50,000. I didn't provide you information about any contributions he'd made during the year, so line 1 is blank. We go on to line 6 and we enter his account balance at the end of the year. And then on line 7, we enter the amount that he took as a distribution for the year, which is $20,000. We add 100 to 20 and we get 120. And then we determine what percentage $50,000 is out of 120. So we're going to divide $50,000 of cost basis into the $120,000 account balance. And when we do that, we get 41.67%. That means 41.67% of his distribution will be a non-taxable return of his cost. And that non-taxable part of the distribution is $83.34. So we're going to take $83.34, subtract that from the amount of the distribution, which was $20, and we're left with $11,666 as the taxable part of the distribution. The next stage is to figure out how much penalty he owes on that $11,666. So we go over to the 5329 and we enter $11,666 as the amount of early distribution that could be subjected to the penalty. Is he eligible for any exceptions to the penalty? And the answer is yes. He's eligible for an exception to the extent money was spent on that health insurance while he was unemployed. So we're going to enter exception code 7, $2,000 on line 2, and that's going to reduce the amount of taxable distribution that's going to be subjected from the penalty down from $11,666 to $9,666. We multiply that number, $9,666, by 10%, and we get $967. So now we know what we need to do. We need to enter $11,666 on line 15B of the 1040. We're going to enter $20,000 on line 15A of the 1040, and then we're going to go to line 59 of the 1040 and enter a penalty of $967 on the form. So we go back to the 1040, we show the W-2 income for the year, $30,000. We show the IRA distribution of $20,000. We show the taxable part of that distribution. We show his total income for the year. We claim his standard deduction, his personal exemption. We arrive at his tax, which is $4,275. We enter the early distribution tax of $967. Add that to his total tax. The withholding is slightly more than that, so he ends up with a small refund of $258. So that's classwork assignment number 2 for you. And let's move back in the manual now to where we left off, which was a discussion about annuity income. And with respect to annuity income, the most common type of annuity I see is this document that is issued by the government to people who have been federal government employees. This is the most common situation where I need to figure the taxable part of a distribution. And I actually need to do it less now than I did in the past. It seems to be more often than not that the government is now figuring the taxable part of the distribution, and I don't even need to be bothered anymore. But just in case you've got some distributions coming out for which you need to figure the taxable part, I'm going to show you how you apply the simplified method to figure the taxable part of a distribution from an annuity. You can see here I've got a little bit of information about the general rule. It almost never applies except in situations listed here. And just because of time constraints today, I'm going to leave you to read about the general rule yourself if you're interested in it. But moving back up to this annuity statement, we're interested in determining what the amount of the distribution is. And you can see it says gross annuity amount. That would be the amount distributed during the year. We also see federal income tax withheld and health insurance premiums that were withheld. I very often see these statements showing health insurance premiums that were withheld. And if you see a number for health insurance premiums, then that should be entered on Schedule A because it's deductible there. Moving on to the simplified method, I'm essentially going to take this annuity statement for our filer who is named Sandy Taxpayer, and I'm going to prepare her simplified method worksheet for you to see. And we'll zoom in a little so it's easier to read. You can see that we have some more information that we need to know about this taxpayer. Firstly, she retired in 2011 at the age of 58, and she has recovered tax-free amounts in earlier years totaling $3,971. We're going to figure the taxable portion of her 2014 distributions by filling out this worksheet. On line 1, we enter the total distributions shown on the annuity statement that she received from the government. And then in box 2, we enter her cost in the plan at the annuity starting date. And that does appear on the form as well. You can see right here it says original contributions. That's her cost in the plan. So we're going to carry the cost in the plan and enter that on line 2. We then say, okay, what is going to be the ratio or the divisor that we're going to use? And we go down to the table at the bottom of the sheet, and it says here, if your annuity starting date was after November 18, 1996, and you are not married, find your age at the annuity starting date, which is the date that she retired, and she retired at age 58, and follow the line across. And when you do that, you get 310. So 310 is brought up to line 3 and entered there. And then next we take 310, divide that into 40,000. And when we do that, we come up with $129.03. That represents the monthly amount that she can recover tax-free. We're then going to multiply that by the number of months that she received payments for during the year, and that was 12 months this year. And when we do that, we get $1,548. $1,548 is the amount that she can recover tax-free this year, provided she has not already fully recovered this original $40,000 cost. Well, she isn't close to having recovered $40,000. She's only recovered $3,971 to date. So we're going to take the $1,548 she's recovering tax-free this year and add it to the $3,971 from earlier years. And that means that for 2014 and earlier years, the amount she has now recovered tax-free is $5,519. But we do all of that simply to determine that the $1,548 that we get this year by multiplying 129 by 12 is going to be recovered tax-free. So we're going to take $1,548, subtract that from $13,900. The difference is $12,352, and that's the taxable amount. So on line 16A, we're going to enter $13,900 on her 1040 form. And on line 16B of Form 1040, we're going to enter $12,352. There's a section here in the course on lump sum distributions, and lump sum distributions are just a really rare animal. Quite frankly, anyone who was born before 1936, and that's who these lump sum distributions apply to, probably retired a long time ago, and the only time you are allowed to claim the tax benefits associated with a lump sum distribution is in the year that that beneficiary takes their first distribution, which anyone born before 1936 has probably been taking distributions for a while. However, it can come up, a lump sum distribution beneficiary could take advantage of this. So let's just suppose that you have a plan participant born before 1936, and they die, and now you are the beneficiary who inherits their plan. and you decide to empty it all out and just take a lump sum distribution and empty that plan out, you would be allowed to take advantage of these particular rules that allow you to use tax averaging and figure out how much tax you would pay if you'd spread the distribution out over time rather than taking it all at once. There is a form for figuring that. It's Form 4972. If you want to take advantage of that 10-year tax option or capital gain rates that might apply in this very unusual situation, you would complete Form 4972. When you complete Form 4972, the most noteworthy thing about it is that the income tax is figured on the form, but the income is not included in the income of the person who is taking advantage of this particular rule. So on the Form 1040, you would show no taxable amount being distributed from the plan. Line 16B would be blank. And instead, you would go over to Form 4972, figure the tax, and then carry the tax directly to the Form 1040 and enter it directly on the Form 1040. And there's a box that you check for Form 4972 when you do that. So a pretty unusual thing. The methodology behind the form is somewhat similar to Form 8814 when you decide to include your child's income on your return. You figure the tax on the form. But I can't say I've ever done a 4972 in all the years I've been in business. It's that uncommon. So we're going to move on now to the last topic of the day, which is Social Security and equivalent railroad retirement benefits. And you'd think, well, there couldn't be anything simpler than Social Security, is there? But actually, there are a few things that I can talk about with respect to Social Security. And since so many people receive Social Security, we need to understand the rules well and also what can possibly come up where we might have to put our thinking caps on to help our clients out somewhat. Now, if you are receiving Social Security benefits, you should receive this form right here, Form SSA 1099. And you can see down here it says Form SSA 1099. That is the document that is issued by the Social Security Administration when an individual is receiving Social Security payments. What can I tell you about this form? Well, you can do voluntary income tax withholding, and if your client is doing that, the amount would appear in Box 6. It's also often the case that payments are being made for Medicare premiums, and so the description amount that appears in Box 3 can include amounts that are being paid for Medicare premiums. You want to see those there. Now, in Box 3, benefits that were paid during the year, if any of those were repaid, you would take Box 4, subtract it from Box 3, and put the net difference in Box 5. But if benefits that were repaid during the year exceeded the benefits received, then it could be that Box 5 is 0 or has a negative number. Anyway, it is possible that you are receiving the equivalent of Social Security, but you're getting it from the railroad. And if you are receiving railroad equivalent Social Security, instead of getting this 1099 SSA from Social Security, you're going to get a Form RRB 1099. And the RRB 1099 is the equivalent of Social Security, and it is taxed in the same way as Social Security. You can see Box 5 of Form SSA 1099 and Box 5 of Form RRB 1099 are for the same purpose, and they're to show the amount of Social Security benefits received during the year. So Tier 1 Railroad is Social Security Railroad. Also from the railroad, you could be getting Tier 2 benefits, and Tier 2 benefits are reported on RRB 1099R. The main difference between RRB 1099R and RRB 1099, well, there's two main differences. The first difference is they're completely different things. One, Tier 1 benefits are the equivalent of Social Security, and you treat them as if they were Social Security. And the other difference is, of course, that the 1099R is going to be the equivalent of a pension. So a 1099R that you receive from an annuity or from a 401k or from an employer-sponsored plan or from an IRA, it's all the equivalent. But when you're looking at an RRB 1099R, the box numbers are all wacky. They're confusing to read, and you really need to get out the instructions for the RRB 1099R to make sense of it. The other thing that goes on is these statements usually are issued by the railroad on a continuous sheet of paper that looks like this one. And you can see that the statement has one blue document at the top, which is the Social Security equivalent, and then underneath it has 3 more green copies, and these are the 1099R equivalent. And they give you 3 copies of the 1099R, thinking in mind that you might file a paper return and need to attach a state copy to show state withholding and a federal copy to show federal withholding when you mail them in. But the format of these documents has pretty much been the same consistently for the last 20 years I've been doing taxes, with the blue at the top, 3 copies of the green underneath. And what you need to remember is that the blue copy means Social Security. It is treated as Social Security, and the green copy means it's pension and it's treated like a pension. Here are the instructions for reading the two forms. We've got explanation of items on Form RRB 1099 Tier 1 Social Security Equivalent, and then we have explanation of items on Form RRB 1099R Pension Equivalent. And then we also have voluntary tax withholdings for Social Security income. So earlier today, I showed you Form W-4P if you want to have voluntary withholding or adjustments to the rate of withholding for your pension plan. Form W-4V is to have voluntary income tax withheld from the Social Security Administration. And what I like about the Social Security W-4V is that for the first time, we actually see that you can withhold a flat percentage amount. So when I'm looking at my client's tax situation to determining how much of their Social Security benefits they should be paying out, I can just look at how much tax I think they're going to owe and figure out what percentage that represents of their Social Security income and select the closest box. Very often the best box for my clients is actually the 25% bracket, because if they are in the 25% bracket and they're getting any other form of retirement income that doesn't have withholding, or very often they actually have other forms of investment income, interest or dividends on which they're not having withholding, this 25% box can come in quite handy. But if they are in a lower tax bracket, there are other options available here. The most confusing part about the W-4V is knowing where to go to find it. You can just type W-4V in Google and it'll probably come up, but I believe you can find them on the Social Security website. The other thing that's confusing about it is it doesn't really tell you where to mail it. Where do you send it? Well, the answer is you send it to the Social Security office closest to the residence of the taxpayer involved. So they're going to have a local office near where they live, and that's the office that they're supposed to mail it to. So there is no single one destination. The next topic we're going to look at is determining the taxability of Social Security. Social Security benefits may be partially taxable or not taxable at all. It really depends on your income. And to figure the taxable part of your Social Security benefits, the IRS has a worksheet. And this is it here, worksheet number 1. You can see it has a bunch of lines on it and instructions on it, and we're going to take a little bit of time to look at this together. So up to 85% of the Social Security or Tier 1 railroad benefits that you receive can be taxable. And to find out whether any of your benefits are taxable, compare the base amounts for your filing status with the total of 1/2 of the benefits you receive, plus all of your other income, including tax-exempt interest. So the first part in determining whether or not your client has taxable Social Security benefits is to know what those base amounts are. There are 2 base amounts to be aware of. The first one is $25,000 if you are single or head of household or married filing separate but did not live with your spouse at any time during the year. And the second base amount is $32,000. If you take half of your client's Social Security benefits and add that amount to all of the other income that they have, and the total is less than their base amount, then none of their benefits are taxable. So that's why it's pretty simple. If you have a client and their only source of income is Social Security, automatically you know that none of the benefits are taxable, even if they're a dependent, because they're going to have that same base amount, whether you're a dependent or whether you're non-dependent. That base amount does not get affected. It's only affected by your filing status. So if you're able to determine that half their benefits added to all of their other income is less than their base amount, you're done. But it's not always that easy, and we do have a little bit more information to relay to you. Also, when you're looking at all of your other income, you should not exclude from income interest that you excluded from income on U.S. savings bonds, employer-provided adoption benefits, the foreign housing or income exclusions, or any amounts of income that you excluded because you were a resident of American Samoa or Puerto Rico. Now, your base amount, as I already said, is $25,000 if you are single, head of household, or qualifying widow. It's also $25,000 if you are married filing separately but did not live with your spouse for any part of 2014. For married filing jointly, it's $32,000, and it is $0 if you are filing separately from your spouse and lived with your spouse at any time during the year. So there's a methodology to the worksheet that I showed you on the earlier page, and I'm going to fill out that worksheet for you. But before we do, I wanted to talk to you about the methodology, because I already explained part of that methodology to you. Take half the Social Security benefits and add them all to all of the other income for the year. And if the amount is less than your base amount for your filing status, you're done. None of the benefits are taxable. But the worksheet itself does take you through some stages of adding in other types of income that might affect your calculation. So I've divided the Social Security benefits worksheet into 2 stages. The first stage is the simplest one. Super simple if you ask me. You don't even need a worksheet to figure it out. What we do in stage 1 is we add up all of the taxable income shown on lines 7 through 21 of your 1040 and add in any tax-exempt interest that's showing on line 8B of your 1040. But do not include any of the Social Security benefits in that calculation. You then subtract out the total adjustments you have to your income, but you add back in the U.S. savings bond exclusion, the foreign earned income exclusion, adoption benefit exclusion, and so forth. And then you also add in 1/2 of your Social Security benefits. Another way to look at it is to say start with your adjusted gross income and then subtract out any amount of the AGI that you think is attributable to Social Security. You're going to get the starting point. You then compare that total that you get after adding in half your Social Security to your base amount and see what you get. So you're going to take the number that you calculate to this point. So you're going to take half your Social Security benefits and all of your other income, and you're going to get a number. Is that number more than your base amount? If it is, subtract your base amount from the number. And whatever total you get, that's pretty much putting you at the end of stage 1. If your modified AGI is less than your base amount, then none of your benefits are taxable. But if your modified AGI is greater than your base amount, then some of your benefits are going to be taxable. We then look at the next step, which is to compare the amount by which your benefits exceed, or the amount by which this modified AGI exceeds your base amount. If it exceeds it by less than $9,000 for a single person or less than $12,000 if filing joint, you're simply going to multiply the difference by 50%, and the number that you arrive at is the taxable portion of your benefits. So how do I know all of this? I just spent time studying that worksheet years ago. When I get a worksheet, the first thing I realize about a worksheet is that the IRS is giving you the worksheet to do a calculation, and they don't want you to mail the worksheet in. So in other words, the worksheet is explaining the rules to you and just giving you a way to go through the rules. But if you understand the rules, you actually don't need the worksheet. So let's see if we can come up with the correct answer without using the worksheet, and then we'll use the worksheet. So here we have Katie, a single filer who received $20,000 of pension income and $15,000 of Social Security benefits. Determine the taxable portion of her benefits as follows. We're going to take her pension amount and half of her Social Security benefits. We add those two numbers together, $20,000 plus $7,500, and we get $27,500. Her base amount is $25,000, so we subtract that out. And we're left with $2,500. The only thing we need to do now is divide $2,500 by 2 or multiply it by 50%. Either way, we get the same result, which is $1,250, and that's the taxable part of her Social Security benefits. So I've completed the Social Security benefit worksheet for Katie. On line 1, we enter the total Social Security benefits we received, and on line 2, we enter 1/2 of line 1. That's $7,500. We add up all of her other income, including tax-exempt interest. She had only one kind of income, pension. We put that on the line. We then total up all of her income, and on line 9, we enter the base amount. She's single, and the instructions for the worksheet say enter $25,000 if you're single, so we do that. We subtract $25,000 from $27,500, and we get $2,500. And then the next step is to see if that is more than the next number on the form, which is $9,000. Well, it's not more than $9,000, so the form simply says take $2,500, multiply that by 50%, and you're done. That's the amount to carry to the 1040. So that's a simpler version of the Social Security benefits worksheet. Now we're going to look at a situation where the income is higher such that the amount on line 10 is greater than $9,000. So if line 10 moves to be a number higher than $9,000, then the formula gets a little bit more complicated. So I've given us a new situation here in just a minute, but let's talk about stage 2 and how it works. So if your modified AGI exceeds the base amount by more than $9,000 if you are single, or $12,000 if you are filing a joint return, then more than 50% of your benefits will become taxable. You're going to multiply the amount by which your modified AGI exceeds 85% and then add that amount to 50% of $9,000 if you are single, or 50% of $12,000 if you are filing joint. And you're going to use the lesser of that total, or 85% of your total benefits, to arrive at the amount of benefits that are taxable. So let's see what happens with that formula in this illustration. Jordan, a single filer, had $30,000 of pension income and $10,000 of Social Security income for the year. We're going to figure the taxable part of his Social Security as follows. We're going to take his pension income, add in half his Social Security benefits, and we get modified adjusted gross income of $35,000. We're going to subtract out the base amount of $25,000, and we get a figure that is $10,000. Well, $10,000 is more than that magic $9,000 number. So we're going to subtract 9 from 10, and we get $1,000. Now we take this difference and multiply it by 85%, and when we do that, we get $850. We then take the 9,000, divide it by 2, and we get 4,500, and presto, we've got the answer to our question. 850 plus 4,500, 5,350. It's going to be either that number or 85% of his benefits, whichever is lower. Well, 85% of 10,000 is 8,500. That is more than the amount we get using the formula, so 5,350 is his taxable benefit. So let's look at the worksheet and see how it fills out. On line 1, we enter the total Social Security benefits. We know that one of the equations we're going to use is 85% of that total. And if we do that, we get $8,500, and I've just taken that and put it on line 18. So that's the worst case scenario, and we're going to go through the rest of the worksheet to see if we can come up with something better. So we take half of line 1 and enter 5,000 on line 2. We add 2 to 3, and we get $35,000. We subtract 25 from 35, and we get 10. We're going to subtract $9,000 from 10, and we get $1,000. We then enter $9,000 on line 13. Then we divide that by 2, and we get $4,500. The next step is to take $1,000, multiply that by 85%, we get $850. We add $4,500 to $850, and we get $5,350. And now we take the lesser of $8,500 or $5,350. The total, $5,350, is the lower number. That's the taxable part of his Social Security benefits. Wasn't that fun? All right. So there may be more than one way to figure the taxable part of benefits, and that can come up. And so we're going to talk a little bit about when the worksheet that I just showed you is not the only method you would use to determine the taxable part of benefits received. There are certain situations where an individual may receive more than 1 year of Social Security benefits in the same year. And this actually happens with all too great regularity, if you ask me. I've become a little bit critical of the Social Security Administration in that I believe that the system is so difficult to break into. If you have a qualifying reason why you qualify to receive Social Security early, such as you become disabled, you've got a doctor's letter that certifies you've become totally and permanently disabled so that you can qualify for Social Security benefits at a younger age. You go into the Social Security Administration to apply for these benefits, that it's almost 100% guarantee, at least in experience with my clients, that the Social Security Administration is going to decline you the first time around. Now, this year I did have a client who applied for Social Security benefits at a younger age due to disability and received them outright without any problems. But based on my experience with my clients, it is far more often the case that when they go in to apply for a Social Security disability, they are automatically declined. And once they're declined, then they have to go hire an attorney to represent them to then turn around and start claiming these benefits. And it can take years, 2, 3, 4 years to get these benefits. And during that time, the benefits are actually accruing. And then when they actually win, Social Security is going to have to pay them all of the benefits due to that point in time, going back years, and they're going to get them all at one time, kind of a lump sum payout. Sometimes that lump sum payout also includes amounts that Social Security has to pay to cover the taxpayers' attorney costs, so they're getting even more again. So they have this huge number that they're having to report as income all at one time in a year. And in a way, you could say it's not fair, because if they had actually received the Social Security income when they should have received it in the earlier years, they were in a lower tax bracket and they wouldn't have had to have paid as much tax. The IRS does have one tool that can be used to get the taxpayer some relief, but it is not as good a tool as perhaps some other methods. But at any rate, it's called the lump sum method, and I'm going to explain it to you now. So certain taxpayers may receive a lump sum payment for Social Security benefits in 2014 as a retroactive payment of benefits for earlier years. Retroactive payments can occur when an individual applies for Social Security benefits in one year and then receives them in another, or an initial application for benefits is declined and then awarded at a later time. Lump sum payments you receive in 2014 that include benefits for one or more earlier years are generally shown in box 3 of either Form SSA 1099 or the railroad equivalent. And I'm going to show you an illustration of what that looks like right here. We have a Social Security benefits worksheet for a character named Mary Tate. You can see that her Social Security benefits worksheet is lining up each of the year's worth of benefits that she received. And when you see multiple years being awarded on a single SSA statement, that tells you that this person can qualify for the lump sum method. The question is, will it help them? And I'm going to explain how it works. But from a practical standpoint, I can tell you it rarely works. It's just a bunch of labor on the part of the preparer to come up with goose egg as a difference. And I'll show you an illustration in our third classwork assignment of the day where it does result in a significant difference. But what I'm finding, at least in the state of Oregon, because we are a fairly high cost of living state, that it doesn't make a difference. I think if you were in a state that has a lower cost of living on average, that maybe you're going to have people who have less income and these formulas work better for them. But incomes are rising due to inflation, and I'm seeing that fewer people benefit from this than I think is originally the intended situation. At any rate, how do you determine whether the lump sum election is going to lower your taxable benefits? Well, you're going to have to go through a few stages. You're going to complete Worksheet 1 like you normally would, where you report all of the income you receive from Social Security for the year, and then use Worksheet 1 to figure out what portion of those benefits are taxable. You then complete Worksheet 2 and Worksheet 4. And on Worksheet 2, you break out each year in turn, and you compare that year in turn to the year that you should have received the money in. So if you're doing a lump sum method, and part of the lump sum method shows that you received Social Security benefits in 2014 that you should have received in 13, then you're going to go back to the 2013 return and pretend that you'd received those benefits in 13. And if you had received them in 13, what amount would have been taxable in 13? So you're essentially doing a Worksheet 1 for 13, except they call it Worksheet 2. So it's all the same calculations as if you'd done it in 13, but you're going to fill out Worksheet 2 instead of Worksheet 1. And then if you received them for any other earlier years, you again take Worksheet 2 and use it in turn for each of the earlier years. You then add up all of the amount of Social Security benefits that you would have received for each of the years on Worksheet 2 and use those numbers to fill out Worksheet 4. And if at the bottom of Worksheet 4 you come up with a lower taxable Social Security income amount, you're going to use the amount that you figured on Worksheet 4. And I'm going to show you how to do all of that in our classwork assignment today. And I think it's a worthwhile assignment because you need to understand how to do it, because it's possibly the case your software doesn't know how to do it. Our company uses Drake software, and Drake software has no mechanism in it whatsoever to do these worksheets. It gives us the form and tells us to hand fill them out and then hard key in the amount that we calculate. So this is literally a calculation that has to be done by hand, at least with the software that we're using. So here is Worksheet 2, and you would enter the earlier year, follow the instructions on the form. Here is Worksheet 4, and on Worksheet 4 it says enter up all of the amounts on all of your 1099s and enter them on here, and you're going to figure it out. So as I said, we're going to do that when we get to our classwork assignment of the day. Making the election, if you choose to report your taxable benefits under the lump sum election method, finish completing Worksheet 4, then follow the instructions at the bottom of Worksheet 4. Report taxable benefits under the lump sum method on Form 1040, line 20D, and then write LSE on the line next to line 20A. That tells the IRS you're using the lump sum election method, and that's why Worksheet 1 is not, which they would automatically fill out, is coming up with a different answer. Do not attach the completed Worksheets 2, 1, and 4 to your tax return. Keep them with your records. Now, once you elect the lump sum method, you can only revoke that election with the consent of the IRS. Some extra notes in here about special Social Security facts you should know. Many different countries in the world have equivalent benefits that they refer to as Social Security within those countries. And the United States, with respect to most countries, does not want you to give Social Security treatment to Social Security benefits coming from foreign nations. But there are two exceptions, and they include Germany and Canada. I can't say that I have any German clients that I've worked with over the years who are receiving Social Security equivalent benefits from Germany, but I do run into Canadians quite often. There is a reciprocity agreement between the United States and Canada. The income that is distributed under the Social Security systems of both nations is mutually reported to each other, and individuals who receive Social Security benefits from Canada as residents of the United States are able to use the Social Security benefits worksheet to figure the taxable part of their distributions or the taxable part of their payments from Social Security, and they report them on line 20 as Social Security benefits received. Now, just to give you a little hint, Canada does not directly call the Social Security equivalents Social Security. They call them Canada Pension. So if you have a client who is receiving benefits from Canada Pension, that should tell you that they're receiving Canada Social Security, and you would do the Social Security benefits worksheet and report the taxable amount on line 20 of the tax return. Special deductions relating to Social Security benefits. Firstly, disability payments. If you received disability payments from your employer or an insurance company that you included as income on your tax return in an earlier year, and you were required to repay those benefits after you received a lump sum payment from Social Security or the railroad, you can take an itemized deduction for the part of the payments that you included in your gross income. If you repaid more than $3,000, you may be able to claim a credit instead. So let's talk a little bit about this situation. I have seen it come up more than once with my clients. You've got an individual who's become disabled. They have to leave employment and begin collecting disability payments from their employer. They are told that they need to go and apply for Social Security disability, and they do so, but they're declined. So during the period that they're declined and going through an appeal, they're receiving these disability payments from their employer's insurance company. There comes to be a point in time where they've gone through all of the resolutions with Social Security. Social Security has accepted that they are in fact disabled and gives them this lump sum payout. And what happens at that point is all of the benefits that they were receiving under the disability plan that was making payments to them now have to be repaid. So the year comes where you get this Social Security income coming in a lump sum, and in that same year, the benefits now have to be repaid. Any of the benefits that have to be repaid to this insurance company are deductible on Schedule A, but if they are more than $3,000, the individual can claim a tax credit instead. Legal expenses, if you paid legal expenses to get your Social Security, you can deduct these expenses as a miscellaneous itemized deduction on Schedule A. If the Social Security repayments you made during a year are more than the gross benefits you received, you will receive a Social Security statement that has Box 4 benefits. And if Box 4 is more than Box 3, there will be a negative number in Box 5. And if your repayments were more than your benefits, then none of your benefits that you received for the year will be taxable. And then if you repaid more than you received during the year, you can enter the excess amount as a deduction on Schedule A. So repayment of benefits that you received during an earlier year. If you receive a Social Security statement with an amount shown in Box 5 that is a negative number, then you can take an itemized deduction for the part of this negative figure that represents benefits that you included in your gross income in an earlier year. And here is an example. Peter and Mary Jane are filing a joint return for 2014. Peter received Form SSA 1099 showing $6,000 in Box 5. Mary Jane also received some Social Security income, and the amount in her Box 5 was negative $8,500. She actually had to make a repayment. Peter and Mary should report 0 taxable Social Security benefits on their 2014 return, and then they're going to claim a deduction on Form 1040, line 23 of $2,500. So that's how to deduct payments of $3,000 or less. They're going to be subject to a 2% limit. So they're going to carry to line 23 of the 1040 and be subject to that 2% of AGI limit. But if the repayments are more than $3,000, then the 2% limit does not apply, and it is possible you could claim a credit instead. So there are 2 different methods to claim a tax benefit from a repayment in excess of $3,000. Under method number 1, you figure your tax for 2014 with itemized deductions included on Schedule A, line 28, not subject to the 2% limit. Under method number 2, you figure your 2014 tax in the following steps. Figure tax without itemized deductions on Schedule A, line 28. Then go back to each prior year for which you made a repayment of those benefits and refigure your tax for that year based on a taxable income amount that is reduced by the benefits repaid during 2014 for that prior year. Figure the difference in tax paid for that prior year from the amount that would have been paid had you not included the repaid Social Security benefits in your income for that year. Subtract the net difference in tax for the prior year from the total tax you calculate on 2014 without itemizing deductions. You then compare the net tax figured under both methods, and if tax for 2014 is less by using method 1, you're simply going to claim the itemized deduction on Schedule A and you're done. But if method 2 results in less tax, claim a credit for the amount from step 3 above on line 73 of your Form 1040, and then in the space on the line, type IRC 1341 next to line 71. Now, if both methods produce the same tax, deduct the repayment on Schedule A. So that concludes the lecture part of today's class. We've got about 6 minutes left to go through an illustration or a classwork assignment that shows the lump sum method. And so let's take a look at our characters in this story to see how that works. Jerry Tate and Mary Tate reside in Costa Mesa, California. Mary retired and applied for Social Security benefits after she was diagnosed with a disability. Initially, her application was declined. Then in 2014, Social Security made a lump sum payment for the prior years and began paying benefits. Jerry and Mary's pension, railroad retirement, and Social Security statements are attached along with copies of their Form 1040A page 1 for 2 earlier years, those being 2012 and 2013. Complete their federal return showing the lowest allowable federal tax for 2014. So here we have Jerry's railroad retirement amount. We've got a contributory amount paid of $18,000. We've got a total gross amount paid of $20,000 and federal income tax withheld of $2,400. We also show a Medicare premium total of $1,259 withheld. And then on the RRB 1099, which is the Tier 1 Social Security equivalent, you can see that he received $12,000 of benefits for the year. Moving over to Mary, on her 2014 Social Security statement, we can see that she's received benefits for earlier years. When we add those up, we get $35,000, but only 12 of those are attributable to 14, and 23 of it is attributable to earlier years. She also received a 1099-R showing a gross distribution amount of $12,000. Let's go ahead and take a look at the earlier years. For the 2012 return, we can see that the pension income they received was $22,500, and none of the Social Security benefits they received is taxable. So the adjusted gross income for that earlier year is $22,500. We go back to 13, and on 2013, the pension they received was $20,000, and again, none of the Social Security benefits that Jerry received in that year were taxable. So it would have been nice to have gotten the Social Security in the year to which it would have applied because they would have had less tax to pay on it. So let's go and take a look at the answer key to this assignment and see what we can do to help the Tates out. So we're going to go through the worksheets, and we're going to fill out a separate worksheet 2 for each of the earlier years. On worksheet 2 for 2012, we take the total amount of Social Security benefit that Jerry received in the earlier year, and to that we add the total amount of Social Security benefit that Mary should have received for the earlier year but received during the current year. When we add those two amounts up, we get $16,000. Then on worksheet number 2 for 2013, we show the amount of Social Security benefits that Jerry received in that earlier year, and we show the amount of Social Security benefits that Mary received in 2014 for the earlier year, and when we add that up, we get $24,000. Then on worksheet number 4, we're going to add up the amount of Social Security benefits that are allocable to 2014 for each of them, and each of them received $12,000 in 2014 for 2014. When you do that, you get $24,000. The next step is to go back and fill out worksheet 1, and on worksheet 1, we're going to show all of the benefits that Mary received in 2014 and add to that all of the benefits that Jerry received in 2014. When we do that, we get $47,000. So now we've figured those starting points, it's time to fill out the worksheets. Worksheet 1, we're going to show that if we fill out worksheet number 1, we're going to take all benefits received in 2014 and divide that by 2. We get $23,500. We subtract out the base amount of $32,000, and we add in all of the other income they received for the year, which is the pension and railroad retirement income that both of them received. And their total retirement income was $32,000. So we're going to add that to half their Social Security benefits, and when we do that, we get $55,500. Now we subtract out the base amount for their filing status, which is $32,000. And when we do that, we get $23,500. $23,500 is more than this $12,000 figure showing on the line. We're going to carry $12,000 and enter it on line 11. We're going to subtract $12,000 from $23,500, and when we do that, we get $11,500. The next step is to enter the amount on line 11 onto line 13. That's $12,000, and we're going to divide line 13 by 2. We get $6,000. We're then going to enter the smaller of line 2 or line 14. This is line 2 up here. Line 14 is a smaller number, and we enter $6,000. Next, we take line 12, multiply that by 85%. So that's 11,500 multiplied by 85%. We get 97.75. Then we're going to add lines 15 right here and line 16 here. When we do that, we get 15,775. The next step is to go all the way back up to the top, multiply the gross benefits by 85%. When we do that, we get 39,950. And that means that the taxable part of the benefits received, the most amount that has to be included in income, is going to be $15,775. But what we're going to do is through worksheets 2 and worksheets 4, figure if we can make the taxable amount of Social Security benefits a smaller number. Do you think we can? And of course, I've written an assignment that will precisely do that. Yes, we can. So we're going to move over to worksheet number 2 for 2012. We begin by entering the Social Security benefits that Jerry received for 2012, which was $5,000, and the Social Security benefits that Mary should have received, $11,000. We add those numbers together and we get 16. We then take half of line 1 and we get $8,000, and we add that to all of the other income that they received for the year. And to figure that, we go back and look at the earlier year's return, and it showed $22,500, so we put that on line 3. We add these numbers together and we get $30,500. That's less than the base amount for their filing status, so we're done. None of the benefits that Mary received in 2014 would have been taxable if she had in fact received them in 12 as she originally applied for and should have received them. We then do the same computation for 11, and we get the same computation for 13, and we get the same result. One of the 2013 worksheet 2, we enter the total Social Security benefits that Jerry received in 2013, which was $12,000, and to that we add the $12,000 of benefits that Mary should have received. When we do that, we get 24. We divide 24 by 2, we get 12. We add that to all other income they received for the year, and we get 32,000. Well, 32,000 is equal to the base amount. That means that it's not more than the base amount, which means none of their benefits are taxable if they'd been received in 13 as they should have been. We take that then we move back to the next stage, which is to figure worksheet 1 as if the 2014 benefits had included only benefits for 2014. And again, Mary received $12,000 for 14. Jerry received $12,000 for 14. We go through the worksheet, this time based on the 14 income. And when we do that, we get 24,000 divided by 2. We get 12,000. Then we take all of their other retirement income for the year, which is 32,000. We add those numbers together. We get 44,000. We subtract out the base amount of 32,000. We get 12,000. 12,000 is equal to 12,000. That means all we need to do is divide the total by 2, and we've got $6,000. So what that means is that if Mary had not received those Social Security benefits for the earlier years, then she would have only had to have included $6,000 of Social Security in her income for the year, rather than $15,775, which we're figuring on the first Social Security benefit worksheet we filled out. So IRS is going to let her take the lower of these two numbers, interestingly, but she's going to have to go fill out worksheet 4 to be sure. And when we fill out worksheet 4, she essentially arrives at the lump sum election amount being $6,000. So she's going to go over to the 1040, and on line 20, she's going to enter $47,000 as the gross distribution. She's going to enter LSE. On line 20B, she's going to enter $6,000. So that means that the total income for the year is $38,000 rather than a much higher number that we figured under the first worksheet. So that is how we figure the answer for classwork assignment number 3, and we are done with today's class. So let me go ahead and give you the final password of the day so you can check out. So password number 3 is NEO, N-E-O, NEO. So we have a little bit of time left at the end of today's class to take a look at the 2 homework assignments that we've created. They're relatively simple assignments, but they're just one more opportunity for us to take the rules relating to pension and Social Security income and report those on the tax return. Homework assignment number A involves preparation of a tax return for Fred Flintstone. You're going to need to do a Schedule B, the Social Security benefit worksheet, and then obviously complete his Form 1040. Fred is married to Wilma. They are both retired and they're filing a joint return. Fred and Wilma's Form 1099-Rs and Social Security statements are attached. They also received a Form 1099 INT that reported the following amounts: Box 1 interest of $2,500 and Box 3 interest of $5,000. I wanted to point out as a reminder that when you see a 1099 or a substitute 1099 INT that is reporting income in certain boxes, you should know what that income means. Box 1 interest is ordinary interest income, and Box 3 interest is U.S. government bond interest. U.S. government bond interest can receive a limited amount of special treatment on the federal return. One of the special treatments available on the federal return is that you can exclude from taxation U.S. bond interest that was spent on higher education. However, in this case, the Flintstones did not spend any money on higher education expenses, so that provision does not apply to them. Aside from that, U.S. government interest is more applicable at the state level because the states are not allowed to touch U.S. bond interest. So in terms of how the federal government taxes U.S. bond interest versus ordinary interest, in the case of the Flintstones, it's identical treatment. Let's prepare the Flintstones tax return. So here we have the 1099-R for Fred, and we can see that he had a gross distribution for the year of $18,800, but his taxable amount is less than that at $17,000. He also had $1,000 of federal tax withheld. On Wilma's 1099-R, her gross distribution and the taxable amount are the same number, and she had $600 withheld. We then have Wilma's Social Security benefit statement showing $3,000 of benefits for the year, and Fred has a Social Security statement showing $6,000 of benefits for the year. Let's go ahead and prepare their return. So I now have in front of you the answer key for the homework assignment. You can find a copy of this answer key under the Materials tab of the LMS. So let's take a look at this particular tax return. I mean, in the world of tax returns, this is a pretty straightforward one. We're dealing with taking pretty straightforward numbers and entering them on the return. The first number that we look at is the interest income from the 1099-B, totaling $7,500. We're going to enter that on a Schedule B, and then carry it to line 8A of the tax return. Also, we have two 1099-R documents, one of which shows a partially taxable distribution and the other one of which shows a totally taxable distribution. The total distributions from the two 1099-Rs are $34,800, but the taxable amount is $33,000. So on the Form 1040, we're going to enter the total distribution on line 16A and then carry the taxable part of that distribution on to line 16B. The Flintstones also received a total of $9,000 of Social Security benefits, and to figure out how much of those benefits are taxable, we're going to need to complete the Social Security benefits worksheet. So let's take a look at their finished return. On line 8A, we show the interest income that was received for the year. On line 16A, we show the gross distributions from the retirement accounts for the year. And on line 16B, we show the taxable part of those distributions. Then on line 20A, we show that the gross amount of Social Security benefits received is $9,000. And I've already shown you also that the taxable amount is $5,350. But let's go to the Social Security benefits worksheet to see how we figured that. Remember, on the Social Security benefits worksheet, we begin on line 1 by entering the total Social Security benefits received. We then look at the total of all income on the return plus half the Social Security benefits. So if we go back up to the 1040, we have $7,500 of income plus $33,000 of income. We take those two numbers and add them up, and we have $40,500. And to that, we are going to add half the Social Security benefits, which would be another $4,500. So let's go back to the worksheet. And we can see that we've got that $40,500 amount, and we're going to add in the $4,500 amount. When we add those numbers up, we get $45,000. The next step is to see, where does this $45,000 figure in terms of the base amount for a married filing joint return? And the base amount, we can see for married filing joint, is $32,000. $45,000 is more than $32,000, so we're going to subtract 32 from 45, and that gives us 13. And on line 10, we enter 13,000, which is the difference between line 8 and 9. And then we subtract 12,000 from 13,000 to get $1,000. The next step is to take that $12,000, divide it by 2, and we get $6,000. And then the instructions for the form say, take the smaller of line 14 or line 2. And in this case, line 2 is a smaller number, so we take $4,500. And then we take 85% of $1,000, add that to the $4,500, and when we do that, we get $5,350, and that is the taxable amount of the benefits. The other document I did want you to take a quick peek at is the interest received from ABC Bank. That is reportable on Schedule B. And moving back over to the tax return, we've now entered $5,350 on line 20B. The adjusted gross income is $45,850. They are allowed a higher standard deduction because they are both age 65 or older. They're also allowed to claim their personal exemption deduction. They have taxable income of $23,150, tax of $2,569. They have $1,600 withheld, and so they do owe $969. And the next assignment we're going to look at is another super simple assignment. This one involves preparation of Form 5329. In this assignment, we have a character named Betty Rubble, and she is married filing separate. Her husband, Barney, did not itemize his deductions. Betty resides at 2030 Triceratops Way, and during the year, she received $1,500 of interest from her Port of Galveston bonds, and she also cashed in and received $500 of interest on her Series EE savings bonds, which she used to pay for higher education. In February of 2014, Betty began full-time studies at Texas A&M University. She withdrew $4,000 from her IRA, of which she spent $3,000 on tuition and fees. Her 1099-R is attached. Also, Betty was employed part-time. Her documents are attached to prepare her tax return. So we have the gross distribution from her retirement account, her IRA, $400 of tax was withheld, a distribution code of 1, meaning an early distribution with no known exception. We also have a W-2 showing $9,000 of income and $800 of withholding. Let's prepare Betty's return. So there are some key points to take a note of with Betty. First off, because her filing status is married filing separate, she is not going to be allowed to exclude any of the interest income on those U.S. savings bonds. That particular exclusion is not available when you have the filing status married filing separate. The other deal is that even though she was attending school, she's not going to be allowed to claim the American Opportunity Credit or the tuition and fees deduction or the Lifetime Learning Credit because, again, those education benefits are not allowed when you use the filing status married filing separate. However, there is one benefit she is going to be allowed to take, and that is that she is going to be able to exclude some of the distribution, or perhaps even all of the distribution that she took from her IRA to the extent it was spent on higher education expenses. So let's go take a look at that tax return for Betty. And we can see we've entered her wage income of $900, we've entered her U.S. bond interest of $500, and also her Galveston tax-exempt interest is entered on line 8B. On line 15, we've shown that her distribution from her IRA is $4,000, and she has adjusted gross income of $13,500. So the question is she going to be able to get out of any of the penalty for the additional tax on IRAs? And the answer is yes. She spent $3,000 in higher education expenses, and we are therefore going to complete Form 5329 in Part 1. We will enter the total early distribution that she had. On line 2, we will enter the part of the early distribution that was spent on qualified higher education expenses. That was $3,000. And that leaves her with an amount subject to the penalty of $1,000. The additional tax she owes in that $1,000 is $100. And we go ahead and enter that on line 59 of her tax return. So we figure her standard deduction at $6,200, her personal exemption at $3,950, her tax is $338, but she has to add in that early distribution tax of $100, bringing her tax to $438. She did have a decent amount of withholding, though, $1,200 of withholding, and so ultimately she has a refund of $762. So that completes the review of the homework assignment for pension and Social Security income. For those of you who are taking this as a self-paced course, you should now move on to the final exam. And for those of you who are taking this as a webcast, thanks for participating, and we hope to see you again soon. Bye-bye. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.